Okay, sorry, it's just loading.
And we are live on YouTube.
Okay, super. Over to you, Mr. Williams.
Thank you. So, Megan, everything is operational. We are being recorded. Megan, everything is working?
Sorry, yes, I just had two audio feeds there for a second. Threw me right off. Yes.
Very good. Good afternoon. My name is Earl Williams, and I am a member of the Land and Property Rights Tribunal, which the Municipal Government Board and a number of other boards were integrated to form the tribunal this year. I would, before calling the hearing to order, I would just like to go over a couple of matters relating to protocol. Megan has outlined a number of elements related to the process of having a virtual hearing. The importance of, if you lose signal, either audio or video, that you reach out to Megan as soon as you can. Also let myself or members of the panel know that you've encountered difficulty so we can stop and not proceed too far in the hearing, and then without having everybody linked in. So if you have any problems, please immediately identify it. That way we can stop the hearing and back up to the appropriate point. A virtual hearing is quite different than in-person hearings. The visual cues are different. The nonverbals are totally different. So I ask the parties for patience, and especially patience when it comes to speaking. Sometimes we can end up speaking over each other simply because of delays and the way the whole thing's flow. So it's just a matter of, and it's not that it's not there, I'm just reinforcing that, and this also applies to myself and to the panel, to be respectful when it comes to the whole matter of the speaking to each other. That again, the nonverbal signal cues are there, but if something happens and you need, kind of wave, or if I ask if everybody is in agreement, you can just use a thumbs up or thumbs down. We can use certain signals to move the hearing forward. So are there any questions? And breaks. Breaks are expected. If for any reason you need a break, just please identify it and we'll proceed with having a break. If the panel wants to caucus and take a break, we will do it accordingly and advise you. So breaks are accepted, are part of the process, especially when we're doing video hearings in a virtual hearing perspective module. So I'd now, but prior to calling the hearing to order, I have a very unique request. So if I could ask both, Lawrence, Lance, how do you pronounce your last name?
It's Waylagi.
Wheelag?
Waylagi.
Waylagi. You must be Welsh or something.
I believe it's German.
German, okay. I had a hearing where there was two Welsh gentlemen on the call, and that was an interesting process with names. Waylagi, have I got it?
That's close, yeah.
That's close enough. And Mr. Cook. The question, this is the first time that the members, my side panel members, have participated in a CARB hearing involving hotels. I have 10 years on the Municipal Government Board, and I think in that period of time, I don't think I've heard 10 hotels yet. And they were all concentrated in a period of 2016 to 2018. My recollection is hotels are, the valuation approach for assessing hotels is different than any other property, that there's consideration for actual accounting numbers. It's there's a little bit more of a one-on-one perspective to it. So what I was asking, and it's an easy question to ask, I'm just not sure how we'll go at it, and that's why I'm putting it forward to the two of you. It would be really great if there's some way that between Mr. Willaggy and Mr. Cook, that you could just give an overview at a high level as to how hotels are assessed, to kind of bring the knowledge base of my colleagues on the panel to a level. I think it'll help us not be asking a lot of questions. We're going to ask a lot of questions, but a lot of questions around process. So do you see what I'm driving at, gentlemen?
Yes, yes. Mr. Cook, do you mind if I take a stab at it?
Absolutely not. Lance, go ahead.
Very
Okay,
good.
you fill in what I miss. So, Mr. Chairman, members of the board, assessments for hotels, you're very, very right. It is unique in the circumstance that we do require each property's financials to prepare the assessment, their income and expenses. So every year, the assessor sets out to send a request for information to each hotel and request the income and expenses of not only the previous operating year, but actually we use 3 years. Reason being is hotels are volatile in nature. They're a very short-term income stream where from day to day, week to week, month to month, the income stream can move up, it can move down, it's very volatile. So what the assessor seeks to do is look at 3 years of financial information in an attempt to stabilize those 3 years to reflect a stabilized net income, which of course is just an annual representation of our estimate of how the property would, what the property would generate by way of the net income. We then, of course, capitalize that by the respective capitalization rate into value. So there are pieces within that process that are, again, specific to hotels. For example, with hotels, you look at what we call a going concern. So you have realty items and non-realty items. You have, so for example, we have the tangible realty in the land and the building. We have tangible non-realty, and that of course being the TVs, the bed sheets, the furniture, those type of things. And then of course you have essentially non-tangible non-realty, which is any sort of business value that the operation has essentially generated or built over the operation or life of the hotel. So we have certain categories that we look at the property as a whole with respect to its income and expenses, and then we make appropriate deductions not only for the operation of the real estate but also for the non-realty item, well, the tangible non-realty items. Sorry, the tangible non-realty items in the FF&E, and then of course the non-realty non-tangible item in the business value. So what you see there is in the assessment is ultimately the value of just the land and the building, the real estate only.
You're muted, Mr. Cook. I think you were going to.
No, I'm quite satisfied with Mr. Willaggy's explanation there. I think that was quite fair and reasonable. And I think that both of us will address the methodology in our submissions.
Very good. Is there any adjustments that you make to recognize what's going on, industry adjustments in your financials or in the numbers you put in front of us?
So that's the attempt in the stabilization process. So so because the income stream, like I say, is very volatile. So something that's really on the tip of our tongue is obviously the impact of COVID on hotels, but obviously there's other economic factors that will have an impact on the short-term income stream of a hotel. So in an attempt to try to smooth out the income or represent a fair annual net operating income, we go through the stabilization process. So anything that's impacting the income stream on a day-to-day basis, we try to smooth that out through the stabilization process. In addition to that, sir, we also undergo what's called the normalization process. So you could stabilize a specific hotel, their 3 years of financials. But the next step is what we call the normalization process. So the assessor would actually look to comparable hotels to determine whether the actual stabilized income falls within a reasonable range, or if the income or expenses would need to be adjusted accordingly.
And when you do that normalization process, are you using national industry standards or local industry comparable standards?
Typically, you would develop those from the local market with respect to, say, expense ratios. For example, an expense ratio for a certain hotel might be between 60 and 70. And if the stabilized income would come in at 65 for a particular hotel, the assessor might accept that 65 as being within a reasonable range of well, not only the actual, but competing market comparables.
One other question that I have, the capitalization rate, and you undoubtedly will get to that in your material. Local or a wide sample?
So we've been very lucky in the town of Canmore. We've had lots of activity and transactions over the last 4-5 years. So we are able to develop a capitalization rate from the local market.
Thank you.
Not always the case, though.
No. Mr. Cook, any comment? Do you feel that the questions I've asked have gone too far in scope? Are you?
No, Mr. Chair. In fact, I think your questions are right on point and are addressed directly in my submission. Thank you.
Very good. So having covered that, I would like to now formally call the hearing to order. My name is Earl Williams, as I've already introduced myself. I'm from the Alberta Land and Property Rights Tribunal. I would like to ask my colleagues to please introduce themselves. And I would normally say right or left, but I don't know who's right or left in this virtual environment, but I'll lead with the lady on our panel.
And she manages to unmute herself. Hi there, my name is Andrea Williams. I've been on the Assessment Review Board in Canmore here for the last 2 years. This is my 3rd year. Yeah.
Thank you. My other colleague.
My name is Martin Buckley. I'm a resident of Canmore, retired municipal administrator. I've been on the Assessment Review Board for Canmore, the MD of Bighorn, and the town of Banff. Primarily with the MD of Bighorn for the past 2 years, and the town of Canmore as well. I've had one hearing in the town of Banff. All were LARB hearings, local assessment review board hearings. So,
Thank you. I should just point out to the parties, there is no relationship at all between Ms. Williams and Mr. Williams. So just happened to have a common name here. So on behalf, I'd like to now move to on behalf of the complainant who is here and the agency you're with, please.
Yes, good afternoon, Mr. Chair, members of the board, Mr. Walagi. My name is Stephen Cook and I'm representing the complainant, Avison Young.
Thank you. And on behalf of the respondent, please.
Yes, good morning, Mr. Chairman, members of the board, Mr. Cook. My name is Lance Walagi. I'm a partner with Benchmark Assessment Consultants, and I'll be here on behalf of the town of Canmore as the respondent here today.
Very good. I assume there's no file management matters, all the evidence has been filed, et cetera, so we can just move forward now. Very good. I would like to now ask, I should mention that, and this is again for input from the representatives of the parties. The board would like to be able to ask questions of clarity and information during the presentation of your evidence, just so that we're kind of keeping current as we're proceeding through the material, rather than saving questions like clarity questions to the end. Are you comfortable? Our questions will not get into a lot of depth, but it's just so that along the way, we are ensuring we have an understanding of what's being presented to us. I've seen a thumbs up from Mr. Cook. Do I have another? I have double thumbs up. Thank you. So we will take that approach. Very good. I'd like to now ask Megan, the clerk, Megan-clerk, to read in the particulars of the property that is in front of us today.
Yep, so today, this hearing is for tax roll 15838 for the property at 1 Silvertip Trail. The legal description for that is Lot 1, Block 17, Plan 9711512.
Very good. And the current assessment of that property?
The current assessed value for that property is $9,741,000, and it's assessed as assessment code 20, which is land and buildings commercial.
Thank you. Do the parties accept the particulars as provided by the clerk for the town of Canmore? Thank you very much. I would like to now identify the evidence disclosures that have been filed. We have 3 documents that have been filed, all within the required time parameters. Document C1, and I'm taking that, if I recall, is around 40 pages. That is the complainant's disclosure, C1, and my number is 40 pages. Is that correct, Mr. Cook? Have I got that?
That is
number
correct.
right?
Thank you, Mr. Chair.
Thank you. And on behalf of the respondent, I have a disclosure which will be referred to as R1, which has been filed by Benchmark Assessment Consultants on behalf of the town of Canmore. And my numbers tell me that this is 76 pages in length. Is that correct? Very good. And I also have another document, the rebuttal, filed on behalf of the complainant. And that document is 6 pages in length. Is that correct, Mr. Cook? Thank you. So those are the evidence disclosures that we have in front of us today that are on the record and will be the basis in combination with the verbal testimony on which we will make our decision. Are there, prior to proceeding to the merit hearing, are there any preliminary matters to be raised in respect to the file before us today? Very good. On that basis, I'd like to now proceed to the merit hearing. The process is one that we're all familiar with. The complainant will make their presentation. We will then move to questions, initially from the respondent, then questions from the board, then questions arising. Then we'll move to the respondent's presentation, questions from the complainant, questions from the board, questions arising. We will then move to the rebuttal evidence. Complainant will present the rebuttal, questions from the respondent, questions from the board, questions arising. Then we move to respective summaries. The summaries approach that I use is summary by the complainant and summary by the respondent. That's the approach that's been used in the city of Calgary. Are the parties comfortable with that summary approach? Or did you want to have last kick at the cat, Mr. Cook?
Thank you, Mr. Chair. Typically, if anything arises out of the summary of the respondent, the complainant is given an opportunity to redress that, much like a rebuttal.
You know what? Let's take that approach. You'll go first on summary, then the respondent, and if there's something that's been raised in which you would like to be able to succinctly comment on, you got that opportunity.
Thank you.
Okay? Are you comfortable with that, Mr. Walagi? Thank you. And through the entire process and prior to the summary, you can be as detailed as you want in order to provide all of your information and make sure everything is presented. When we move to summary, I ask that the parties that summary is succinct, to the point, identifies the issues, what the request is, and what supports the request. That is not an opportunity, as both of you know, to present any new evidence in that in the final summary. Very good. So if there is no questions, let us now move to the complainant's position, starting with document C1. Mr. Cook, I am going to mute my microphone, and it is all yours.
Well, thank you, Mr. Chair and members of the board. Very good opening, make everything clear. Appreciate that. Just for the record, I'd like to note that I have no objection to any members sitting and deciding upon this appeal.
Mr. Cook, I missed that point on my checklist there, and it was checklist point number 7, and I will now formalize that. So, and number 7 says, the chair asks if either party objects to any member of the board hearing the file. Mr.
No.
Walagi, I have a thumbs up. Thank you. And, it just reminds the chair, follow the checklist. That's why I prepared it. So thank you very much. Mr. Cook, is there anything else that I missed in the introduction?
No, sir.
Thank you very much. Mr. Walagi. Very good. Now let's come back to course here. And Mr. Cook, please, the complainant's case.
Yes, thank you. Again, members of the board, Mr. Chair and Mr. Walagi, we are here, as has been adequately and sufficiently described, to hear an appeal on a hotel. In this instance, it's the Holiday Inn in Canmore. On page 1 or the cover sheet, you'll see the assessment for 2021 this year is $9,741,000 even. And we're here before you to request a value of $7,750,000. On page 3 of my exhibit C1, you get a brief description of the property, and I'm sure many, if not all, are aware of this property in the town of Canmore. It's a 99-room property built in 1997. And as my good friend, Mr. Walagi, pointed out, it has been assessed quite properly on the income approach to value, i.e. it's an income generating, producing concern. And the assessor's quite right. It looked to that income and then, of course, apply a capitalization rate to render a final value, or in this case, an assessed value of $9,741,000. It's very true, you do not hear many hotel appeals. Indeed, frankly, all the properties I appealed this year from a hotel perspective, and as you can probably imagine, every hotel operator owner has been in extreme distress and concern this year over the values. We typically negotiate with them, the assessors, and total respect to my good friend. In this case, we were unable to do that. So be it. That is why we're all here today. The issue, there are 2 issues that I'll get to shortly on page 4. They are the assessed stabilized income, as you heard my good friend give a brief rendition of how that's arrived at. And secondly, as an alternative approach, the assessed capitalization rate. I won't go into great depth because I think everybody's very well aware, ad nauseum, of course, on the current and the existing conditions for 2020 in regards to not only oil and gas revenues and the impact that had on the marketplace, but also the obviously effects of the pandemic. And I will get into that briefly and shortly, but I'm not going to dwell on it too much because I think it's we're all sick to death of hearing about it or suffering through it. Anyway, the reason why we're here is that the 2020 assessment of this property was 8,466,000. And
I'm sorry, Mr. Cook, that is the 2020 assessment?
yes, the previous year's assessment,
And how much was that?
8,466,000.
Thank you.
So as an opening gambit, you can imagine the surprise, the unpleasant surprise that was greeted with when it hit the doormat of the hotel operators, considering the marketplace we're in. And I will get into that shortly as well. So there are two issues that we're looking at, as I indicated on page 4, stabilized income as how it was calculated by the assessor, and the capitalization rate as an alternative and secondary approach to validate the first approach. On page 5, and I'm sure everybody's fairly familiar with all these are just photographs, maps of the subject site, the hotel, just to give you an idea of what we're dealing with within the, just off the main highway going through Canmore. And those photographs and maps are up to page 8. And then on page 9 is the assessment details for the subject property. This is what is mailed to the owner. And it can't be missed because it's in a very bright yellow format. Good job, Canmore. So the property as assessed, you will see in the top right is 9,741,000. Following pages are the actual assessment summary that's upon request was kindly provided to me by the assessor. And you'll see again a very brief, page 10 just shows the amount, 9.741 million. And on page 11 is a bit more detail. It details the income that was utilized to arrive at that assessed figure. And just as my good friend stated, it shows the potential gross income in the middle, and then there are deductions for typically for expense ratios, non-recoverables, reserve for replacements, and FF&E, which is furniture, fixtures, and equipment. And then applied is to the net operating income is a cap rate of 8% in this case to arrive at the final value of 9,741,000. So that's basically the process of how these values are calculated. And indeed on page 12, we've run it through our own system, and we get slightly different in dollars and cents, but essentially it's the same thing. Obviously we're using the same factors, just reproducing it in a Davis and Young spreadsheet format. So having received this, of course, I got a phone call pretty quickly from the operator. And on page 13, I want to reference for initial, whenever we look at these assessments, generally speaking, we look to, is it a reasonable increase? Is it a reasonable decrease? How does it compare to the prior year? The subject 2020 assessment versus the 21 assessment. And as I indicated earlier, the 2020 assessment for the subject property was 8,466,000. And that's shown on the following page, which is page 14. You will see the 2020 notice that was sent out to the taxpayer. And you'll see I've highlighted in a red box on the halfway down on the left-hand side, that assessment of 8,466,000. So, of course, we're not used to that. In fact, it's the only increased assessment I've had in the entire province for the year, and I have looked at a lot of hotels. Across the province, in recognition of the devastating effects of the pandemic, hotel assessments were reduced between 10 to 50% year over year. And those huge 50% reductions were actually here in Edmonton and and I'm in Edmonton, by the way, and some in Calgary. In the rural districts, I say rural, I mean non Edmonton and Calgary, I hope I'm not offending anybody. Were in the 15 or 25% typically. However, the subject hotel is the exception to this recognition of the declining revenue streams, as it was actually increased, as you can probably tell from the numbers, by some 1.25 million rounded or 13% rounded. This clearly is unfair and unwarranted, and it's obviously a shock to any taxpayer to get an assessment that is completely atypical or different from all their competitors. So the chart below shows a change in assessments from 2020 to 2021 of selected hotels across the province as a result of the effect of the pandemic. And I say selected because I needed the assessments, I need the detail sheets, and these are all, I wanted to be similar hotels to the subject. The subject's a Holiday Inn, and the majority of these are Holiday Inns. There's a Hampton Inn in there as well, and a Ramada Inn, all of a similar ilk. Just to be reasonable, I'm not going to the bottom of the barrel, I'm not going to the top of the barrel. I'm sitting, I think, fairly, one would say Holiday Inn is in that middle. So you see across the province and these municipalities, I've indicated on the left-hand side location, the property name, where available, some are not available. When in discussion with other assessors across the province. And then I've shown the 2020 assessment, the 21 assessment, and the change year over year. And obviously these vary, as you can see in the far right, but you will note that every one of those, of course, was a negative in brackets. The range was from a low of, I think, 15% to a high of 48%, with an average and a median very, very similar, 27% rounded negative. The subject, however, astonishingly outperformed every one of these with a 13% increase year over year, which is why we're here. So to go on, page 14, as I indicated, is the prior year's assessment. So first thing we did on page 15 is request from the owner the financial records, the report. So page 15 is the revenue performance for 2020. Now, acknowledging, yes, sorry.
Mr. Cook, just want to confirm, and this also is for my colleagues, that the assessment of a hotel is done on the period of July 1 to June 30th, right? And the valuation date will be July 1 of 2020, based on data from July 1 of 2019 to June 30th of 2020. Do the parties agree that that's
Yes.
how it's done, right?
Yes, absolutely.
Okay, very good. I just wanted to confirm that for all three of us on our side here, that it was very clear that this was a period. Very good.
Correct.
Proceed. I'm on page 15. So,
Mr. Chairman, just really quickly, yes, and with, of course, specific to hotels, we would use that 3-year period. So in that case, we'd go even further back 2 years prior to that for all the hotels. So, but yes, you're correct. Leading up to the value.
I'm just going to feed that back, Mr. Walagi, that the current assessment is based on the 12-month period of July 1 to June 30th as of July 1 of that year, but you use data that goes back a 36-month period from the valuation date for data that you utilize in the calculation and determination of the assessment.
Correct.
So you go back as far as would be July 1 of 17 for data.
Correct.
Through to July 1 of 2020.
Correct. Yeah.
Thank you. Are there any questions from my colleagues around this 1 year, 3-year period? Okay, thank you.
May I continue, Mr. Chair?
Oh, certainly, yes.
Yeah. Thank you. So indeed, you're very sharp, as you quickly pointed out, the relevant timeframes from an assessment perspective. However, as you can probably imagine, hotels typically report on an annual basis, i.e. they're not behooving to the assessment departments, they're behooving to their investors. And typically financial statements run from January to December on an annualized basis. And so it's still not a problem because the assessor can quite easily review and calculate the relevant time periods. But anyway, notwithstanding that, we have the financial statements for 2020, recognizing the subject was bought in mid 2019. So the numbers on this page of the report is shown at the bottom of the page, but they're very small, certainly from my old eyes. And so on the next page, 16, I've reproduced the very same page, but enlarged it, hopefully, so it's visible.
Mr. Cook, just want to confirm, the subject property was purchased by the current owner, and at what time?
It comes later in my submission, but it would be, I believe it was mid 2019. I think it was
Got it.
March or April, but I will confirm that when I get
Got
to
it.
that.
But it was just a note that the subject was purchased by the current owner in 2019.
Yeah.
Thank you.
You're welcome. So when I look at the 2020 income statement and a larger version, these revenues range from a monthly low of, let's say, 15,000. I'm going to round up and down to make it easy. And that was March 20, the start of the government shutdowns, to a high of 380,000. That was in July of 2020, which is the prime month tourist-wise. And the total 2020 revenue equated to 1.75 million, just to be convenient. This, of course, is significantly lower than the assessed total revenue of 3.75 million, which represents the revenues from July 1, 2019 to June 30, 2020 by the assessor by almost 2 million, or over 100% higher. So you can see there's a massive differential here. As a consequence, we believe it's far more reasonable to look at the most recent 12 months of 2020 to base the assessment on, as they better reflect what was happening as of the condition date of December 31, 2020. So in other words, we know very well now, obviously as of condition date, we were well aware of that the pandemic was not a temporary blip for a month or three. Indeed, it's now entering its, we're over a year and a half into it. So it's not a short-term thing, unfortunately. It's a significant economic driver against revenues, as shown by the 2020 statements.
So, Mr. Cook, just confirming here, this page 16 is the January to December year,
Yes,
and the column total gives us that 12-month period
that's right. Yeah.
with your operating revenue coming down to I'm just kind of, you got the reserve here.
Mhm.
You quoted a net number, and I'm just trying to find that net number.
Oh, the number I quoted is, if you look at total, second column from the end on the right,
Yep.
you will see total operating revenue of 1,763,282.
Yes,
That's the number I quoted from page 15. And
yeah, okay.
yeah, and the assessment record showed earlier the assessed value, assessed income was at 3,741,900.
Okay, so the assessed income was, again, 3 million, what was it?
741,900.
And the income here that shows in the total, so the income for the 12-month period of 2020, right,
Yes.
was 1,073,000.
No, 1,763,000.
63, yeah.
And just for clarity, the figure of 3,741,900 is in the assessment record as shown on page 11 of my submission, and it will definitely obviously come up in the respondent's submission as well.
Right.
That's where it was derived from. So obviously there's a significant differential, and it's clearly driven by the pandemic. So I looked on page 17 to the subject's revenue for 2019. And you'll see these total revenues range from a monthly low of 156,000, which was November, to a high of 935,000, which was July of 2019. And the total equated to 3,845,000, very close to what the city assessed the year at. But of course, this was in a non-pandemic year. And again, I've reproduced the 2019 chart at the bottom of the page and reproduced it in a much larger format, readable format on the following page, page 18.
And this is for a June to December period.
Right, absolutely. So what have I done? I've looked at the 20 and looked at the 2020 performance, looked at the 2019 performance on a month-to-month basis, and it's obviously no surprise to anybody that 2020 significantly underperformed 2019, as it did for any hotel in the province, specifically in tourist areas, as for obvious recognized reasons. So on page 19, we look to stabilization just like the assessor does. We want to follow as closely as we can to be fair and equitable. So on page 19, having displayed the significant variance in revenue performance over the two time periods of 2019 compared to 2020, it's reasonable to go back to the required assessment time frame of valuation date, July 1, 2020, and go back the 12 months, just as the town did and just as is legislated. We're not using any income from July to December of 2020. We're going back to the appropriate time frame of July 1, 2019 to June 30th, 2020. But in recognition of the dramatic effects of the pandemic, appropriate weighting should be used in order to recognize much lower revenue streams, as has been done elsewhere across the province. Consequently, in the chart below, we reproduced the monthly revenues for each month from June 19 to June 2020 and applied weighting of 35% for the first 6 months and 65% for the second 6 months, January to June of 2020, to better reflect the impacts of the pandemic. This is in contrast to the assessment-derived income of 100% weighting across the entire time period. So much as the assessor weights over a time period, they weight the results 20% 3 years prior, 30% 2 years prior, and 50% for the current year. Because the pandemic is so significant, as you could tell from prior pages, we believe equally weighting should be applied, but the pre-pandemic and the post-pandemic as much as we could within that time frame. So instead of 100% weighting across the entire year, we're suggesting 35% for the first 6 months pre-pandemic and 65% post-pandemic, secondary 6 months.
Mr. Cook, how does that, could I ask you to just step back? How does that compare to what a non-pandemic approach, put us in a non-pandemic period, okay? You're dealing with the 3 years, right?
Right.
If you could just review that for us, please.
Yes, and as my good friend, Mr. Walagi already indicated, in a non-pandemic scenario, i.e. in prior year, you would go 20% 3 years prior, 30% 2 years prior, and 50% for the immediate year prior.
And what are those percentages? That's the weighting that you're assigning.
Yes, to each revenue for each year. So what we're doing the same thing, but obviously we only have a 2 year period. The hotel's only been owned for the 2 years. We don't have, unfortunately, the prior year's revenue. But with all due respect, the pandemic is so significantly varied. We believe far more weighting should be applied to it. And we have a 2-year period. So we're saying it can't be 50-50 because there's such different years as a percentage. So we're saying 35% and 65% more accurately reflects the effects of the pandemic. And with all due respect, I think not that same approach, but a similar approach obviously results across the province where reductions are on average 27% year over year. So in the chart below, what we've done very simply is we've taken every month, July 19 to June 20, so all within the valuation period. We've indicated their monthly revenues, all the other revenues to get a total revenue. This is all taken from the financials. And you see, if you look at the middle of this chart, there's a column entitled total, and you'll see a figure of 3,748,871 as the total of those 12 months, which exactly is the 12-month period. And we've shown a column to the right of that assessed weight. In other words, the assessors given each month equal weighting. So 12 months divided into 100% is 8.333 recurring for weighting. We have applied as I indicated, 35-65% weighting. So the first 6 months will get a 5.83 recurring weighting, and the secondary 6 months will get a 10.83 recurring weighting. In other words, we're reflecting the pandemic effect.
So Mr. Cook, so in this is a 12-month period, July 19 to June 30th, 20.
Yes.
This table that's provided here is a table from the respondent?
No, it's from, well, it's from the owner. These are taken from those 2 pages prior with the financials.
So you're saying that what you want to do for assigned weight, instead of equally, you want to assign what weight for the July 1 to the December 31?
We want to assign 35% for that period, and which is equivalent to 5.8% per month. As opposed to 1/12 from the assessor, it's slightly lower, of course. And then the secondary 6 months, where the pandemic was much more what was in place, we're assigning 65%, or divided by 6 months is just over 10%. In a weighting formula is all we've done.
Okay.
And so
thank
can
you.
I ask where the numbers came from, the 35% and the 65%? These are your views as to?
Right. Good question. There's of course, no one predicted we'd have a pandemic, and nobody predicted the effect. So there's nothing inscribed, nothing in writing. It's really a value judgment. We're trying to be fair. We're saying it clearly can't be 50-50 because the 2 time periods are vastly different.
Mhm.
So we're trying to be reasonable, and this, as I show with the results, I think came up with the most reasonable end result or value request. So having done that, you'll see if you look at the bottom line, the total line of the chart, you will see that the weighted income from the assessment, this is the third end column, the weighted income per month is 312,406, and our requested value is 248,105. So it's less based on that approach and principle. That's the only change we're making, is changing the weighting. The result of a 248,105 monthly weighted income is 2,977,256, as opposed to the assessed 3,748,871, or assessed income. So just to give you an idea, it's less by approximately 20%, maybe a little bit less than that. And as I indicated, the revenues across the province is 27%. So The effect is to produce a more reasonable total income pandemic affected 2,977,256 compared to the assessed revenue of 3,741,900. So on the following page, again, I've just produced a larger version to be easier to read. Now, just to put this in, I hope to clarify this. On page 21, I've produced a chart. I think pictures say 1,000 words. So as I pointed out, the average requested monthly revenue is 248,105 compared to the actual assessed monthly revenue of 312,000. And if you look at the chart below, it can be seen that the actual monthly revenue is lower than the requested value from September 2019 onwards, showing the reason of the request. So you'll see I have a chart. On the left-hand side, I have revenue up to $1 million per month. And on the bottom axis, 1 to 12, that's the months. So that's from July 2019 to June of 2020. Now the blue line, which dominates by going from left to right in a downward trajectory, is the actual revenue. The gray line, which is represents 312,000, is the assessed revenue per month. And the orange line is our requested. So you can see that we're here to request a lower value than assessed, but it's still, for most of this chart, represents a higher requested value than actually was performing in those 12 months. Just to give it a diagrammatic overview, which we believe shows how fair and reasonable the end result is. If in answer to an earlier question, we'd asked for 20/80 weighting, it would have been close to the actual performance. And if it was 10/90, of course, it'd be below. And we don't think those are reasonable. So we're trying to be reasonable in our request. You can see on that chart how the 50/50 as assessed outperforms the actual performance. So on page 22, this is our requested assessment. We've simply inputted our market revenue in red. This is our weighted revenue. And of course, expense ratio, non-recoverables, reserves, and so on remain the same, including the cap rate in this position. Requested value is 7,750,000 rounded. Now, this is a value that is supported in that across the province, as I indicated earlier, hotels have seen reductions in that 15 or 60%. And this value would represent a reduction of just 9% from the prior year. So it's still less than remember the average and median was in the 27%. The lowest across the province was 15%. This is only requesting a 9% reduction year over year. Still much higher than any other assessment that we came across. So that was our primary approach to the request, to recognize the effects of the pandemic. That assessments shouldn't be increasing year over year, they should be decreasing. Our calculations and chart supports that position. Now on page 23, as I indicated at the outset, there's a secondary, we wanted to test, should always test your results to make sure they're reasonable. I mean, we could have come up with any numbers and come up with a 5 million request and said it's reasonable, but wanted to validate and test the approach. So I looked at the cap rate because, of course, cap rate is a reflection of risk. And in good times, cap rates typically are low. And in bad times, typically the risk is higher and the cap rate increases. So on page 23, I moved on to a secondary test because, again, we're based on the income approach to value. So you can only argue the income or the cap rate. They're the two fundamental components in the formula. So I looked at the, again, the assessment, and it's assessed at a 9% cap rate against the the income is generated by my good friend, the assessors. So as an alternative and secondary approach to market value, by reviewing the actions of assessors across the province again in their hotel assessments, the following chart depicts the assessed cap rates of similar hotels. Again, I'm looking at similar hotels. I'm not looking at the bottom of the barrel or the top of the barrel. I want similar typical properties. And you'll see I've indicated that I could find 6 hotels in 6 regions. They're all Holiday Inns with the exception of one, but it's the same Super 8. I've described the number of rooms to again show their similarity. There is one Holiday Inn in Edmonton that's larger. Other than that, they're all fairly one of the same. I've shown their 21 assessment values, and then I've shown their cap rates. And you'll see that across the province here, the low is 9%, the high is 12.25%, and the average is 10.25%, and the median is 9.5. So a very tight range for cap rates. The subject is at 8%, significantly below all the comparables. So again, using our best judgment, we've suggested that the subject tourism was especially hard hit. Canmore, of course, is a beautiful place with a significant drive for tourism. So we're requesting if as a secondary test, you use a 10% cap rate, which is fairly in the middle of the average and the median, it would be appropriate. The following pages, and I'm not going to spend much time on these because they're just supporting documents for all the assessments. You see they all look very similar, these sheets, to the subject. These are all across the province, and they show the cap rates just as support for our request. They show the varying cap rates between 9 and 12.5%. And they go through all the comparables all the way through to page 29. And I don't intend to spend much time here because I don't, the assessor acknowledges that we all know it, the effect of the pandemic on the hotel industry. But for example, just in case I was in the education business, page 30 is, these are just extracts from the newspapers telling us what we already know. Page 30, this is the Canadian Federation of Independent Business, showing the first paragraph, shows the hospitality industry has been the hardest hit sector in Alberta by the pandemic. According to the CFIB, only 6% of Alberta restaurants, hotels, and caterers are currently open, and 57% are at risk of closing permanently. The point of this is this impacts on risk, obviously, when there's such a low number open and risk of closing, it impacts on the cap rate. More risky the business, the higher cap rate you would expect. Similarly, page 31, this is all quotes from the CFIB again. And on page 32, they reference again, the hardest hit was hospitality, restaurants, hotels, caterers. And it states at the top of page 32, hospitality may see 27% of businesses close, and arts and recreation 30%. I mean, these are staggering numbers for an industry. They impact on cap rates. Obviously, the lower the revenue, the higher the risk. Similarly, on page 33, this is Calgary. Calgary's tourism industry has taken a catastrophic hit during the pandemic. And the first paragraph, it comes as no surprise to those in the tourism industry that COVID-19 has delivered a devastating body blow to the local economy. But some new numbers reveal just how deep the wounds are. Calgary's $2.5 billion tourism industry, already facing an economic downfall, now has a much longer and challenging road to recovery. And so cap rates look to the future, not to the past. There's the element of risk going forward, not the element of risk that's already occurred, because that's historic. And then you'll see at the bottom of the page, hotel occupancy. When the pandemic began, hotel occupancy in Calgary plummeted to just 3%, but it has since risen to 18%. But these are catastrophic numbers in the tourism industry. A high of 18% when they're used to going at 65 to 75%. Catastrophic numbers. Indeed, next paragraph. These numbers are much lower than the last year when hotel occupancy in Calgary was listed at 70%. So I'm suggesting in my earlier calculations that you cannot use equivalent weighting for pre-pandemic and during pandemic because they're such vastly different times. It has to be reflected. It's so atypical. And so on page 35, as a test, purely as a test, I don't want to upset the apple cart on equity in Canmore or indeed in the industry, but you'd have to recognize that cap rates will increase because of the higher risk and because of closures, bankruptcies, and so on. So if you used a 10% cap rate and everything else stayed the same with the income approach from the assessment, the value would be 7,792,260 or 7,792,000. This number is incredibly close to our requested value based on our weighting and the income approach, which was 7,750,000. We're within less than 0.5%, way less than 0.5% out. So it's a very good secondary test to validate our initial approach by two independent approaches to value. So turn to page 36. In our final conclusion then, and indeed 37, we took two approaches, but of course our main weight focuses on the actual performance of the subject, much as the city did, the assessment did, for the year under appeal. And the requested resulting value is 7,750,000 rounded. Mr. Chair, members of the board, the balance is again reproductions of the financials, which we relied on for our request in the relevant time periods. And I thank you very much for your time and consideration. Thank you.
Thank you. Questions from the respondent, Mr. Walagi?
Thank you, Mr. Chairman. Can everybody hear me okay? Perfect. Yeah, a few questions through the chair, of course, to Mr. Cook. Thank you for your presentation, Mr. Cook. Very well done. I just have a couple questions for clarification, if you'll bear with me for a little bit here. On your page 15, and I guess subsequent page 16, these of course are the same financials presented. This is a period from January 2020 to December 2020, and that was the sum, which you referenced earlier, of the income at 1,763,282, correct?
Yeah, so can I do the thumbs up as well?
Yes, that works as well. Yeah, do that. Okay, and just to clarify, you're not asking the board to consider that period in time because that's half of that period is after the valuation date, correct?
Yes, quite right. I totally agree with your earlier comments and presentation. Yes.
And then moving backwards a bit to page 13, you had mentioned that the basis for the complaint here today was largely because of the increase and not so much on the overall assessed value, correct?
Well, I certainly said the first part. My owner is a lot more vociferous than I am. They, to put it politely, believe it's way over assessed, but I don't look to opinions of assessments too high. I just look at the facts and the numbers. So I understand the frustration of the owner when they get an increased assessment, but yes, it's principally, from my perspective, it's based on the facts of the matter as presented, and then I did the research to see whether it was a reasonable demand or not.
Sure. Okay. So I don't want to put words in your mouth, but sorry, it sounded like the property owner who had just paid 17.5 million wasn't so much as upset as a $9.7 million assessment, which is, roughly half of what they paid, but they were more so concerned for the increase. Whereas you might kind of look at the whole picture. So from their perspective, they're worried about the increase. You're more so looking at the full picture.
Sorry, dancing. Can you hear me now, Lance?
Yeah,
Yeah.
you bet.
Sorry, I keep missing the connections there. I don't want to put words into the client's mouth or mind, but they typically do budgets every year. When they purchase a property, they base it on what the taxes are, for example, and what the anticipated taxes are over the next 3, 5, 10 years even. So obviously their budget was way out when they received the tax notice, and they felt that based on the, to quote, catastrophic conditions, that the assessment was too high.
Okay, so I guess in part it was put forth to you due to an increase, not so much the overall value then.
Again, A, the increase, and B, they felt the value was too high based on their current revenues. But of course, I look at the time period that's reflected in the assessment.
So they paid 17.5 million. They look at an assessment that's 9.7 million, and then they say to you, we think that's too high.
Right, and I know you know this, but just for the benefit of the board, again, hotels are very, very different to other revenue earners, i.e. industrial warehouses, office buildings, and so on, because there are so many other, as you pointed out at the outset, so many intangible, non-realty items that are related in a hotel purchase. The purchase price of a hotel never comes close to reflecting the real estate value of the property.
And moving on to, I suppose, the weighting, which is on page 19. So you mentioned that all of the other hotels in Canmore were prepared using the weighting of 50, 30, 20, as you kind of explained to the board there. So ultimately, by recommending to the board a different, Mr. Chairman?
Earl, you're muted.
Thank you. So I'll just, you spoke quickly there and I couldn't keep up. I couldn't even get to the button, right? So you're saying the other hotels in Canmore, that the weighting that they used, could you just give me the weighting by year that you understand was used, which then leads to the question, right? So
that's correct, yeah. So the weighting, as of course used by the assessor and understood by Mr. Cook there, was 50% for the most recent year, 30% by the middle year or the previous year, and then the last or the furthest back year was 20%.
So it's 20, and I'm just going to take January dates here, July dates. 20% at July of 18, 30% of July of 19, and 50% of July of 20.
Perfect. Yep.
And so your question is, and I'm not putting words in your mouth, so if I understood it, you're saying that this is what it's been. And Mr. Cook has done something different. Is that correct? Is that where we're going here?
You've read my mind. My question to Mr. Cook through the chair is essentially just that. Can you confirm that you're asking the board to accept a different weighting for one hotel, whereas the same process has been done under the same circumstances, i.e. everybody's been affected by, of course, this pandemic. You're asking the board to accept a weighting specific to this property, which is different than the other 20 plus hotels in Canmore.
Yes, Lance, obviously I'm not privy to all the assessments of all the other hotels, but I'm very prepared to accept your position that they are. And so in that instance, yes, that would be correct. They are not under appeal. The subject's under appeal.
So in a sense, to shorten it up, you're asking the board to create an inequity for your hotel or your client's hotel versus all the other 20 plus traditional hotels.
Well, with all due respect, it already has been treated by the assessor in an inequitable manner because it hasn't already received the 20, 30, 50. The assessment, as you will point out shortly, was based on actual. So the inequity already exists. We're just propositioning a reasonable inequitable approach.
And just to wrap up here, Mr. Cook, so on page 22, so this is your requested assessment. So you're essentially, because you have two calculations here, and I think you did a good job of kind of walking the board through both calculations. I just want to confirm. So the main calculation that you're asking the board to do is on page 22. So in a sense, you're saying, you know, to the board that if you accept your argument on the income side, you're okay with the cap rate.
Right. The primary approach obviously was the income as impacted by COVID. The secondary approach was a validating approach based on a cap rate argument. And I acknowledge fully that the rest of the, from your disclosure, the rest of the assessment for the hotels are also done at an 8%. It's a secondary approach which supports the first approach, but our main weight is on the first approach, income approach.
Thank you, Mr. Cook. That's all my questions, Mr. Chairman.
Before I move to my panel, I just want to follow up on that one point, and this is directed to Mr. Cook. Mr. Cook, if I understand what Mr. Walagi asked, he said that if on page 22 is the income based on your analysis outlined on page 20, right? And the cap rate that was used by the respondent. So that on the request on page 22 is based on the complainant's view of the income and the respondent's cap rate. Are you then saying that another option to do the assessment of this hotel is if you take the income on page 35, and I'm abbreviating it to the 3741, which is the respondent's cap rate, no, the respondent's income, then you're asking for a cap rate of 10%?
Yes, that's correct. That was our testing approach to the first approach, yes.
Right. So in front of the board is income as we view it, cap rate per as has been done in the assessment, or take the cap rate, the income from the respondent and use our cap rate. It's an A or B choice as you presented it to us here.
Yes, essentially, yes.
Got it. Thank you. And I didn't understand that when we started, that there was a couple options here. And I just wanted to clarify that even for my colleagues before we start getting into things. So we'll now move to questions, and we'll start with my colleague, Ms. Williams, please.
Thank you. I only have a couple of questions. Just going back to page 13 of the presentation, just wondered if, obviously, there are a number of hotels in Canmore, and the assessments that you have used in your table, just wondered if you could elaborate why you chose those locations.
Yes, good question. I'm looking for, in the assessment, in the legislation, you got to look at similar properties.
Mm-hmm.
And there are no other, to my knowledge, directly similar hotels to a Holiday Inn in Canmore. To my knowledge, they're all, and I'm not being detracting that. There's a lot more mom and pop kind of operations in Canmore, bed and breakfasts and motels and smaller ones that have far different expenses, costs, et cetera, compared to a franchise or a flag like the Holiday Inn. So I went across the province with as many Holiday Inns as I could put in, because these were all the same owners, same type of property, and accessibility, because I had that information. I didn't have any of the information for these smaller properties in Canmore itself.
Okay. Thank you. And my other question just relates to the income. Now, I know you said your client purchased the property in 2019, I believe.
That's correct. Yeah.
And so we only have 1 year of income available. Presumably, just a question, was this information for the prior owner not available?
Right. I couldn't get it. Obviously, it's a very different operation. I don't know whether it's much lower or much higher. Typically, when these things are bought, the buyers think they can do a much better job and make more profit in them. So I suspect it was lower, but I'm just guesstimating. I don't know.
Okay. That was really all I had. Thank you.
Okay. Thank you.
Thank you. Mr. Buckley.
First of all, thank you, Mr. Cook. Your presentation cleared up a lot of things for me, and I really appreciate what you had to say. I wanted to build on Ms. Williams' question on the comparables on page 13, though. I appreciate what you were saying about franchise hotels versus mom and pop operations, but I look at some of the municipalities you've gone to, and Canmore and Banff, Jasper, and I believe Drumheller have been petitioning a province for resort status because that's the basis of the industry here.
Yeah.
These other places that are listed here wouldn't appear to be resort places. Did you try Banff or Jasper or heavens knows Drumheller, I guess, for figures?
Again, Mr. Buckley, thank you for your kind comments at the outset. Again, I was looking at franchised similar properties to the subject. I certainly didn't have any information. I'm not even aware of any in Banff or Jasper. There could be, but I can only use the data that I have available to me. And as you can imagine, a lot of these are competitors to my clients, and they're not going to freely give me their financial statements. But I did talk to many assessors, as you can see, across the province, and where I could get the information, that's what I presented. To be clear, the point of this was just to show a trend in the marketplace, which isn't unexpected. We anticipated that declining occupancy rates results in declining values, of course. And so all this did was it showed me what was happening across the province from municipality to municipality, that they were all going down. Of course, they were in varying ranges, as I indicated, from 10 to 60%, but it just showed me what the trend was, and I wanted to present to the board how the subject is far outperforming all the remaining hotels as expected. But when I produce a financial statement, there's no justification for its assessment increasing rather than decreasing, as is typical.
I see. I guess when I brought forward the resort status situation, I also know that at least some of these municipalities you've compared to could have seen decreases, not just from COVID, but from, for example, the oil and gas industry downturn. And I wonder what effects that have on the situation as well.
Absolutely. Very good point. Many of them do. Although there are variances with every town, as I've dealt with the assessors in Fox Creek and Whitecourt and so on. But the point, not now, but if you look later, at page 30, I introduced narrative from publications where they referenced the tourism industry specifically, and this was how hugely impacted they were. And obviously Canmore, Banff, Jasper would be, as I said, prime tourist destinations.
Okay, I appreciate that. Thanks again. That's the extent of my questions, Mr. Chair.
Thank you. Okay, Mr. Cook. I have a number of questions, and just to ensure I've got everything correctly laid out here. If we go back into your package, and let's just start at page 9. And to me, page 9, 10, 11, and 12 is simply saying my client's property was assessed at 9741, and here is documentation that relates to the 9741. And page 12 is you've just run the number on your spreadsheet to show how the 9741 was determined. That the assessor used the income of 3741 and the cap rate of 8, right?
Exactly.
Okay, and then on pages 13 and 14, and I'm not putting words in your mouth at any time, okay? I'm just trying to clarify. What we're saying on 13 here is the industry has been taking a beating through COVID, and page 13 shows me that. And page 14 is, here's what it was assessed at 8466 in 2020. Grant you, every year is its own assessment period, but delete the but. For the assessment year 2021, I'm at 9471. 9741, right?
Yes.
That's the message from there.
Yes.
Now, you then show us on 15 through 18, you're showing us the ownership of this property. I'm just going to say the property was acquired Q2 of 19,
Yes.
which would be what? April till June, right?
Yes.
So you then show us the first year of financial statements from July 1. No, you're showing us on page 16, the calendar year of 2020, right?
Yes.
The assessment year would have been from July of 19 to June 30th of 2020, right?
Yes.
So this is just giving us a broader picture of the property. And you're showing me the total income was $1,706,000. I had expenses, I had department profit, I've had the undistributed, and I end up, I'm trying to get to what my net number was after everything. I have a hotel profit here.
It would be at the bottom there, the EBITDA, which is the third line from the bottom.
Yeah, and I wasn't sure if that was positive or negative.
It's positive.
A 325, I'm using a magnifying glass here. So
Yeah.
325, 550 is the EBITDA.
Right.
And then you take us and show us 2019, which is basically, I've taken from June, this is basically the period that the hotel has been owned by your client,
That's right.
which gets us down to an EBITDA of $1,207,000
Yes.
based on the last 7 months of 2019.
Yes.
And we went into COVID lockdown in 2020. So this is the first 7 months of under the new ownership, right?
Yes.
So I just want to. Now you bring us to page 19. And on page 19, the typical stabilization would have been 20, 30, 50 over 3 years. And if this hotel hadn't been sold, the stabilization would have been 20, 30, 50. Is that right?
It would have been if they had the financial records.
Oh, yeah. Oh, no, I'm assuming, sir, that, Mr. Cook, if the property had not been sold.
Again, if the previous hotel operator had submitted the financial records, then absolutely it would be based on a 20, 30, 50.
Right. As the new owner, your client does not have any of the previous financial records.
No.
I'm just trying to make sure that I'm understanding that the reason we've taken this 12-month period outlined on page, initially on 19 and then enlarged on page 20 is because this is new ownership.
Yeah, this is based on the information that we and I believe the assessor have. I think the assessor and I are both in the unfortunate position that we don't have the history of this property.
Okay, what is the practice of the assessment of hotels when a property has changed ownership and the income, the financials are not available from the previous owner? I mean, we're dealing with pandemic here of COVID. I'm just trying to understand what's the normal practice.
Okay. A caveat, I think, in all fairness to my good friend, Mr. Walagi will be better able to answer any questions pertaining to assessment practices. But I will say that quite rightly, the assessors rely on mass appraisal and typical. So if they don't have the information, they will fall on typical, which is exactly what the assessor did for the prior year.
So I'm just trying to understand that. So because only 1 year was available, the assessor took the 3741.
Right.
And you're okay. What you've asked, if you could just now we're on page 20. And instead of taking the 37, and I'm looking at page 20, the total column, total column, 3748.
Yes.
Okay. So what you're asking the board is, instead of taking the 3748, I want you to, instead of putting you want to distribute the weighting differently, don't you?
Yes.
And that's what I'm just trying to grasp, is that if we'd had 3 years, this year would have got 50%. I don't have 3 years here. So you're saying instead of taking, the assessor takes 100% of that number.
Right.
And you're saying you want us to take 2.9 of the 37.
Right.
And what's that number as a matter of interest?
It is shown on page 22, and it's actually shown at the bottom of the page, page 20. It's shown under requested income.
Yeah. I'm just saying that you're asking, you're taking 2.9 of, I'll just get my calculator here, 2.9 of 3.7, right?
That's right.
Roughly 80%.
So you're asking that the assessment be prepared on 78% of the income. Correct?
I haven't done the calculations, but I'll take
Yeah.
your word for it. Yes.
And what is the rationale for that 78% and the distribution. I think my colleague asked about what was the basis for that 35-65 split.
Right. Good question, and this, hopefully I can make it clear. The reason why the assessor does not take the actual income of 1 year is because they say you must stabilize and rationalize.
Correct.
Totally understand and agreed. So they take a 20, 30, 50 based over 3 years percentage. We're saying in a micro way, because we don't have 3 years, we have 1 year, you should adopt the same approach. The 20, 30, 50 is supposed to eradicate peaks and troughs. And we're saying the same thing, that in 1 year, you can't treat the first month the same as the last month, or indeed the first 6 months the same as the secondary 6 months or last 6 months, because they're so vastly different. So to stabilize the income over the year, we're suggesting that the weighting, instead of being 100% for each month, it be 35 and 65 to reflect the pandemic effect. That's simply, it's the same theory. It's just we're dealing in micro 1 year as opposed to macro with 3 years, because we don't have that data.
So you're saying that normally you would stabilize 20, 30, 50. However, in the case of the subject property, you have but 1 year. And let's just put COVID to the side. Would you have asked for a stabilization like this if this was a normal operating year?
No, because one would anticipate that the results would be normal.
Got it. So now we bring COVID into the equation, and you're now saying, and please, I'm not putting words in your mouth, Mr. Cook. I hope you understand that.
I do.
Just articulating where my mind is processing.
Yes.
You're saying we don't have 3 years on this property to stabilize. If we did, we would have done the assessment on a 20-30 split, and that would have been it. You're saying we've got 1 year, and because this 1 year has been impacted by factors that are not normal, if I can use that term, you want us to go to a stabilization of 35-65, and that's 5.8 per month over the first 6, and 65 divided by 6, which is, we're going to round here, virtually 11% per month for the last 6.
Right. Right. So by extension, what I'm saying is the city I say the city interchangeably, my good friend, Mr. Walagi, the town of Canmore, they have assessed based on a 3-year time period because they recognize that not every year is the same. Right. And I'm saying the same, so the same principle applies here. If you only have 1 year's available data, then you've got to look at weighting. If you had 2 years, would you go 50-50? No, because if you had 1 year that was fantastic and 1 year that was terrible, you weight the most recent year, you'd give the most recent production greater weight than the dated historical. And that's all we're doing. We're saying there's such a difference that the most recent time period should have greater weighting than the more dated time period.
Right.
That's all we're doing.
And the 35-65 comes from where?
Again, from my head, from my analysis, again, I played with the numbers, I calculated it, and I could have gone 20-80, but I didn't. I thought the results were not fair or reasonable. So I settled on, I thought 35-65, because the revenue was so drastically different. It depreciated, I think, 47% or something. So I thought 35-65 was an approximate mathematical result.
Yeah, you have revenue in July of 19 of 881, and July of June of 20 of 119. So, right? And I'm just looking at the first revenue number.
Right. So there it's 12% of the revenue, but I wasn't going there. I certainly, I understand that I'm trying to be reasonable, and
yeah.
not trying to be greedy.
Right. It's a judgment call, a judgment call
Absolutely.
in your professional opinion that with the 1 year, let's do a 35-65 split, which takes us to the number. Now, when we come to page 22, and my apologies for drilling down into this. I just want to get this picture sorted out, Mr. Cook.
I'm
When
quite
it
enjoying
comes-
it.
Pardon me?
I'm quite enjoying it. Good job.
So we have the 2977, which comes from your page 20, right?
Yes.
And then when it comes to the expense ratios and the non-recoverables and the reserves and the FF&E, where are those numbers coming from, those percentages?
They come from the assessment detail report that was presented earlier that the assessor adopted and used in the
Got it.
assessment.
So what you've done is you've accepted the assessor's, I'm going to call it factors, right?
Yeah.
For these components here. You've said,
Yes.
yeah. So we're not into any of that. We're into what my revenue was for the purpose of assessment, which is page 22, or the cap rate. We'll take, with all due respect, Mr. Rolagi, and I'm not being flippant here, we'll take his numbers, but apply my cap rate. Mr. Cook.
Yes. Again, I presented the argument that it's a high-risk, volatile marketplace, typically, blah, blah, blah.
Yep. So now when it comes to the cap rate, page 23, is there a corporate relationship between your owner and any of these other properties? I wasn't sure how to read that when I heard you refer to it.
Yes. I was looking at similar properties, and the most similar to subject Holiday Inn you can get are other Holiday Inns.
Agreed.
So
Yep.
there, a couple of them have similar partners, but they're not all owned by, these are all franchises. Obviously, there's hotels and multiple groups own multiple hotels. So
Got it.
they all have the same branding, but they're not necessarily the same owners.
Right. So it's a matter of you selected hotels that are Holiday Inns with comparable size, and hence Holiday Inn gets you a branding, which tends to get you a certain point in the market.
Exactly. I'm trying to compare apples to apples.
I think I'm just about there. But I'm going to reserve the right to maybe come back later. So,
Granted.
so your cap rate at 10%. Where did that come from again? That came from, did you do a mathematical weighting or anything, or what's the 10 relative? You just took the mean, straight arithmetic mean to get
Well,
10.25 and then made it 10.
Exactly. The average and the median are quite close, but I thought the result should be in the middle.
Okay. Any questions arising, Mr. Walagi?
No, Mr. Chairman, I think you hit them all.
Any questions from the board? Okay, we're sitting here at 2:50. What I would like to do is go into a 10-minute recess, come back at 3, and start with Mr. Walagi. Before we go there, are there any limitations on how long we run tonight? I mean, we're sitting here, we're coming back at 3. If we're dragging on till 4:35, is that a problem for anybody?
No, Mr. Chairman, not for me. I do have to caution you, though. My daughter does come home from school at 3, and you might hear some noise in the background. So my apologies. We'll try to keep.
I understand that. All of our kids are growing up, but I have a cat that likes to wander in and make cameo appearances some days. So very good. So we're going to mute. We're not going to go to the deliberation room. We're simply going to to turn off our cameras and mute, and we'll come back here in 9 minutes. Thank you, plus or minus. welcome back. Is everybody, their audio is working? I know their video is working because I can see everybody. Megan, is technology still all okay?
Yep, we are on track.
Thank you very much. Now, Mr. Cook, I have a question. When you obtained, you showed us a sample of properties. A lot of them are Holiday Inns. You explained why. And you used that. You had information there around cap rate. What was the source of that? Was there hard data that supports it? I guess what I'm driving at is you have a series of numbers. You get me to 10.25. What underpins those numbers for each one of those properties?
Yes, Mr. Chair, those are the assessed capitalization rates for each of those municipalities. And the conclusion was on page 23, of course, in that chart. Then the following pages were the assessment detail reports as support, indicating what the assessed cap rates were for those properties.
Okay, yes, I had gone and just quickly looked at them and then paper clipped them all together. But what you had to this and what you're saying is that those numbers are the assessed cap rate, period. And we don't
Yes.
know what underpinned those numbers. It's the assessed.
Well, they would be, just as my good friend indicated, they would be based on market analysis.
Right. What I was getting at is you didn't have the market transactions that underpins these numbers. They're numbers that were used by the assessors. Thank you. And my apology for not clearly understanding that. Yeah, and I see it there, the assessed capitalization rate. Thank you. I've made a note, mark beside that. My apologies. I should have caught that earlier. Very good. Let's, we have formally reconvened, but we will now move to the respondent, Mr. Walagi. Document R1, please.
Thank you, Mr. Chairman. Can everybody hear me okay? Audio's all right? Thumbs up. Fantastic. Yes, thanks again, Mr. Chairman, members of the board. Mr. Cook, thank you for your presentation. I'd just like to reintroduce myself, give you a little background about myself. I think this is the first time I've prepared or presented in front of a few of the board members. Maybe Ms. Williams, I may have presented in front of you in a previous hearing, not too sure. My name is Lance Walagi. I'm an accredited municipal assessor of Alberta. I am one of the partners of Benchmark Assessment Consultants. I have roughly 17 years of experience in preparing property assessments for municipalities. Included in that is several municipalities where I do to this day and have been previously prepared assessments for hotel properties. So I'm very familiar with the lodging portfolio and the preparation of those assessments. Some of the municipalities that I currently work in an appointed assessor role or a assistant, we'll say, is the town of Canmore, the town of Taber, the county of 40 Mile, town of Coaldale, the town of Nanton, town of Fort Macleod, town of Colehurst, the ID4, which is Waterton, Foremost, Arrowwood. Overall, our company does roughly 50 municipalities and one nation, the Tsuut'ina Nation. Mr. Chairman, I know there's been a lot discussed here today, and a lot of the information contained within the disclosure, the respondent disclosure, has been talked about already. So in an effort to not repeat a lot of the information that's been discussed here, really my presentation is going to focus in on the issues. It's going to focus in on our position and our response to that position. And I'll do my best to direct the board to the specific pages of evidence and argument that we believe supports that position. At the end of the day, our request, Mr. Chairman, is going to be that we believe the assessment is fair and equitable. And we would request from the board to confirm that assessment. So with that said, before I move into the specifics, I think we're all in agreement, but I do like to restate it. I do believe the issues here before the board there's three of them. And the first is the year-over-year increase from the previous year. Mr. Cook has pointed out that from the previous year, the assessment had increased 13.1%, which on the face of it, when you're in the middle of a global pandemic, seems like it's going the other way. But ultimately, Mr. Chairman, members of the board, there is an answer. There is a reason for that. And I think it's very important that we discuss why the assessment was going up when other similar properties were going down. The second issue is the weighting. Ultimately, assessments of hotel properties in Canmore, and for the majority of the preparation of assessments in Alberta, are prepared using 3 years of financial statements, where the financial statements are stabilized using a 50-30-20 weighting. The complainant, obviously, we've talked a little bit about it. The complainant is requesting from the board, and this is his main argument, is requesting from the board that the weighting be changed for this particular property, but not for others. And so, of course, as an assessor who is mandated to prepare fair and equitable assessments, certainly we take issue with the fact that there are over 20 traditional hotels in the town of Canmore that have been prepared the same way. And, the complainant and Mr. Cook are suggesting that this particular one hotel should be prepared a different way. And lastly is the capitalization rate. So albeit Mr. Cook has said that if the board does accept his change in the income, he's okay with the existing cap rate. But as a backup, he did a little bit of cap rate work, and certainly we believe that a cap rate of 8% is fair and equitable within the town of Canmore, and we'll certainly point that out with some documentary evidence within our presentation here today. So I will be skipping around. I'll try to point out to specific page numbers as I go through. I do tend to move with somewhat of a pace, so feel free to just jump in and stop me if I've lost you. I always go ahead.
I was going to use a manual transmission analogy that I've used the odd time. Assuming it's a 6-speed, could we probably keep it around 3 or 4 for the board as we are flipping pages, making notes, just in case you want us to rev it up a bit?
I'll do my best. Yeah, I'm a speed demon, but I'll try to slow it down for you, sir. With that, Mr. Chairman, if I could get everybody to turn to page 20, I am going to start with the first issue, and of course, the first issue is the year-over-year increase. So, as mentioned, the previous year's assessment was significantly lower than the current year's assessment. The new assessment at $9,741,000 was an increase of roughly 13% from the previous year. And the reason for that, Mr. Chairman, has to do with a little bit of a background with respect to hotel valuation in the town of Canmore. Benchmark Assessments has only been preparing assessments for the town. So this will be our second assessment roll. So the 2020 tax year and the 2021 tax year. So prior to Benchmark Assessments, the assessor who was preparing assessments had not sent requests for information to the lodging properties. They did not collect income and expense information for the preparation of lodging assessments. So when we came in, Mr. Chairman, members of the board, we did not have any information, historical information on any of the hotels with respect to their income and expenses, their financials. And so the first thing that we did in October of 2019 was send out the request for information to start to gather this income and expense information. So go ahead.
So do I take from that statement that you became the assessors for the town, Benchmark became the assessors for the town of Canmore in 2019?
For the 2020 tax year, so late 2019 for 2020.
So you were engaged late 2019 for the preparation of the 2020 tax year, which would have been the 2019 assessment.
Correct. Correct. So we sought to start collecting the financials from the hotels because, as we've discussed here ad nauseum, the hotels are unique in that you do use their actual income and expense information to stabilize, normalize, and ultimately value for assessment purposes. Our first year was for response rate. We only, I don't have the exact numbers in front of me, but it was fairly low. We maybe only got 30 to 40% of hotels submitting. Moving into 2021 tax year, that substantially increased. I think we were in the 80 percentile. So over the last 2 years, starting out, we had no financials. And then over the last 2 years, we've started to build the database, income and expenses for the hotel properties, leading up to obviously this year's preparation of assessment. So why that's important, Mr. Chairman, is for the 2020 tax year, when we sent a request for information to the property owner, the subject property in this case, obviously they only own the property for a few months. It's very clear that they may have known what was going on with the property prior to purchasing the property, but they may not have had hard financials to be confident in supplying or disclosing to the assessor. So at that time, they didn't submit an RFI. So for the 2020 tax year, what we had to do as assessors is look to similar properties, look to the properties that did submit their financials, use the information that was available to us, and essentially derive what we felt was market net income for that property, capitalize that into value. So unfortunately, we didn't have the subject information for the 2020 tax year. Now moving into the 2021 tax year, go ahead, sir.
Whenever you refer to the 2020 tax year, you're referring to the assessment prepared as of July 1 of 2019.
Correct.
Thank you. So then, and now, and this property was acquired in Q2 of 2019. So, okay.
Correct. Correct. So you can kind of see the timing there. They just acquired the property middle of 2019. I sent out the request for information in the end of 2019. There's really not a lot to disclose to the assessor at that time. So I can understand why they may not have supplied any information, given that it was only a couple months. Moving into 2021 tax year, they now have a full year of operation under their belt. And as you can see, I'll move forward a little bit in my disclosure, but you can see on my page 22, so, Mr. Chairman, this was the request for information. As you can see, we asked for those specific 3 years of financials. So July 2017 to June 2018, July 1st, 2018 to June 30th, 2019, and of course, July 1st, 2019 to June 30th, 2020. So for the 2021 tax year, they did only have the one set of financials, and so that's what they disclosed. And they left the previous 2 years prior to them purchasing the property blank, as they may not have solid records of what the performance was of the property prior to them coming in. So from an assessment point of view this year, we still go through the same process, sir. We still stabilize using the 50-30-20, but as it's been pointed out here today, when you're stabilizing 50-30-20 and two of the years are non-existent, ultimately what you're doing is you're applying 50% to 1 year of income, which is ultimately 100%. So in the process of stabilizing, the stabilized income results in the most recent year of financials. And what we found, Mr. Chairman, is now that we actually have income and expense information on the subject property, we realized that the previous year's assessment was underassessed. What we felt was market income for the previous years should have been much higher. And to give you kind of a general background of what lodging has done in the town of Canmore over those 3 years, is we were seeing in general a compression of RevPAR, revenue per available room, ultimately just the income. The income on hotels over those 3 years had started to decline. And you'll see in the complainant's rebuttal that the finance director there, the vice president of finance, she does mention that in her email to Mr. Cook, that yes, over the previous years, 17, 18, 19, and of course we have 20, the income has been declining. So that's the reason, and I think it's very important that the board understands why this property was going up when every other property was going down, or most other properties were going down. For the properties that were in the same boat, where they didn't submit financials in the previous year, but then did submit financials in the next year, they experienced atypical changes year over year. And the reason is simply because now we have the actual income and expense on the information. Now we have a better idea where these properties should slip in with respect to similar properties, and especially in trying to derive a market net operating income when we wouldn't have had any information for the 2020 tax year. So that's ultimately why this property was going up, why others were going down. Simply put, we did not have the information we needed in previous years to make the correct call with respect to the income and expenses. Now, the second issue, which I think is the most important issue, Mr. Chairman, and I'm basically on pages 20 and 21. Again, I want to be to the point and specific and point out the key arguments here. With respect to the weighting, we've discussed this today through the complainant, through questioning. The way that hotels are prepared is based off of 3 years of income and expenses. The assessor would then stabilize that using the 50-30-20 weighting, which is according to best practices. And after the assessor would stabilize those information, the 3 years, he would subject it to the normalization process. Now, the normalization process is very straightforward. We look at where the stabilized income is, where the stabilized expenses are, and we compare those to competing hotels, similar competing hotels. And we understand that hotels are different, right? They have different suite mixes, they have different amenities, they have different locations, ages, etc. So we tend to work in ranges. So for example, for this particular hotel, when we're looking at what other competing properties disclose, their stabilized figures suggested expenses in the range of 60 to 70%. Whereas if you look at the subject's RFI, the actual expense ratio was 68. Now you'll notice that in the calculation of the assessment, the assessor used 70%, so slightly higher. That was due to the normalization process. When we look at competing hotels, we say, okay, they're between 60 and 70%. The subject's at 68. The assessor could have taken 68%, but chose to move that for the benefit of the ratepayer to 70%, the high end of the range. So just as a quick summary, Mr. Chairman, here we have, for this particular property, the subject property, the assessor has accepted by way of income the most recent year, which if we had the previous 2 years, the stabilized income would have been higher. We know this because the VP of Finance has said as such, the income has been coming down in the previous years. So the fact that we didn't have those 2 years to stabilize was actually in the benefit of the ratepayer. They benefited from having a lower stabilized income, which was used in the assessment. Additionally, the expense ratio was normalized up to 70% from 68%. So ultimately, in our opinion, we feel that we've been fairly conservative on the calculation of this assessment. We are very mindful that it does look a little odd when properties, specifically in the lodging industry, have had their assessments reduced, whereas this assessment is going the opposite way. So those are the reasons why year over year you've seen an increase. And those are the specifics into how the assessment was prepared, what was used, what the thought process was, what the specifics were normalized to. And just to wrap up that point, Mr. Chairman, the process for the subject property, the stabilized process 50-30-20, the normalization process, this is all done the same for every single traditional hotel in the town of Canmore. Everybody is treated the same. So I understand that Mr. Cook has put forward some arguments around the board accepting a different weighting because of COVID, but I want to make it very, very clear to the board, all other traditional hotels were subject to the same impact of COVID over the same period. They were all treated exactly the same in the weighting, the stabilization process, and they were all subject to a normalization process. Ultimately, at the end of the day, we feel that the decisions or the reconciled income and expenses used to prepare the assessment were certainly on the conservative side, even if it resulted in an increase in assessment. But that is our position on the weighting. Why we feel the board cannot accept a 65-35 from the complainant is because it simply would create an inequity for all of the other hotels. We have more than 20 traditional hotels in the town of Canmore. They've all been prepared the same way. And what the complainant is asking this board to do is to do something different with this hotel than the others. Now, go ahead, sir.
Question. The subject property only had 1 year of financials. What approach would you take with any other hotel that is only able to give you 1 year of financials? Because of a purchase, change in ownership.
Very good question. So the stabilization process is the same, regardless of whether you submit 3, 2, 1. We are looking at what we can get for the 3-year period, and we're assigning the same specific weighting for each applicable year to get a stabilized income. That process, 100% the same for everybody. Now, when we move to the normalization process, the assessor could potentially make different decisions for a lack of information. Now, that's not the case. That's not what happened here, because as you'll see, as assessors, we know that the income was going to be more in the previous years. And I've made mention to the VP of Finance saying as such in the rebuttal information, which I'm sure the complainant will get to. But we were satisfied accepting the stabilized income of the most recent year and not normalizing that at all. Why did we choose that? Why did we feel that that was reasonable? Because we felt that that was probably the lowest of the 3 years. Now, in practice, there's been several decisions on normalizing income. And because hotels are different, as I mentioned, they have different suite mixes, they have different locations and ages and amenities. Boards previously have decided that it typically isn't appropriate to normalize the income. So typically, when assessors prepare assessments currently, you'll rarely see, maybe under certain circumstances, but you'll rarely see an assessor normalize income. Typically, the normalization process will happen in the expenses. So that's why the assessor for the 2021 tax year looks at that stabilized income and says, you know what, we think it's reasonable to accept the most recent year. Why? Because had we brought in 2 previous, it would have been higher. And this would be the lowest of the 3. This is a conservative amount. We're okay with that. But again, just to summarize on issue number 2 in our position and why we feel it's incorrect to accept the complainant's 65-35 weighting on that 1 year is because, simply put, Mr. Chairman, members of the board, he is asking you to do something that no other hotel was what was done to any other hotel in the town of Canmore. He's asking you to do it specifically for this one, which creates an inequity. For the assessor, our whole mandate is to prepare assessments fair and equitable. That's why we take issue with it. For the board cannot alter any assessment that is fair and equitable. So if we've established that this is the process, this is the way that hotels have been done, this is how all of the hotels have been done, I think it's fairly easy to not accept the complainant's argument by saying we should do something different on this one hotel versus the other 20 plus traditional hotels.
Mr. Wayloggy, if I could ask a question of you.
Sure.
Mr. Chairman, if it's all right.
Oh, yeah.
Just to be clear, knowing that the regulations and the statutes legislation are pretty specific on what an assessor must and can't do, it is within your power or the town's power to use the 50-30-20 or decide to use the 65-35 that 35-65 that Mr. Cook is the complainant is asking for.
Yeah, so
you have that flexibility.
So yes, the percentages are not legislated, right? You won't find in any legislation, regulation, or minister guidelines that says the assessor is required to use a specific weighting. What myself and Mr. Cook have ultimately been arguing and putting forward is what we would consider best practices for the 2021 tax year. I'm putting forward and saying 50-30-20 is typically how assessments are prepared. We feel that of course, every property has been affected by the pandemic. We've given every property owner the opportunity to submit their financials. We've weighted that appropriately and consistently throughout. And all we're asking the board to do is uphold that equity with respect to the weighting of those financials.
Thank you very much. I appreciate that clarification.
Now moving on to my page 23. Now this is sort of I think Mr. Cook would agree, this is really not the main argument that he's putting forth, but as a sort of corroboration for his main argument, he has suggested accepting the income whilst adjusting the cap rate. So I do want to speak a little bit to the cap rate comparison and analysis that Mr. Cook had put forward. On my page 23, and Mr. Buckley had mentioned this through questioning earlier in saying that a lot of the comparable cities, the comparable hotels that Mr. Cook had used to derive his cap rate or his comparable cap rate to which he applied in his secondary approach, it uses hotels that may fly under the same flag, i.e. Holiday Inn, but are not very comparable with respect to the municipality, the area. And Mr. Buckley alluded to it, that the town of Canmore it's a tourist town. It's a resort town. It would be better compared to other similar towns such as Banff, Lake Louise, Jasper, even Drumheller. The fact that the complainant is bringing in information from Drayton Valley, Edmonton, Fox Creek, Slave Lake, Whitecourt, doesn't really pass the smell test. We don't think that these are very comparable. And to demonstrate that, on the bottom of page 23, as a person who wants to spend a single night in one of these hotels in one of these municipalities, you can see that to do so, and of course, all of this documentary evidence, Mr. Chairman, is contained in the addendum, which is at the back of the disclosure, and of course, just summarized in chart form here on the bottom of page 23. But ultimately, what this says is that for someone to come and stay in Canmore, they're going to have to pay a significantly more per night than to stay in any of these other places. It just corroborates the fact that the town of Canmore cannot be compared to these type of properties. It's better compared to other resort type towns. And so we've done that. So if we flip forward to page 25, we're very familiar with the assessors in the three other municipalities, which we feel are better comparable: Lake Louise, Banff, Jasper. And through conversations with the assessors who prepare the assessments of the hotels in these other municipalities, you can see that the assessors have all used the same weighting, 50, 30, 20. They all use the same non-recoverables, 1.5%, the same reserves for replacement, 4%. The FF&E, largely the same at 15%. And the capitalization rates. The town of Canmore, we use 8%. Lake Louise, they use between 8 and 8.5%. Banff, between 7.5 and 8.25%, and Jasper at 8%. So you can see more comparable municipalities are using assessment parameters very similar to the town of Canmore at 8%. And to conclude on that point, Mr. Chairman, if we flip over to page 26, you can see here are over 20 traditional hotels that have been assessed by Benchmark in the town of Canmore. And if you run your finger down the right side of that chart, you'll notice that every single hotel, comparable traditional hotel in the town of Canmore, has been assessed using a cap rate of 8%. Anything other than 8% for the subject property would create, again, an extreme inequity. And it's the same principle, it's the same position as the previous issue. Our position is that this would create an inequity. It's our mandate to make sure properties are prepared fairly, equitably. It's the board's mandate to not change or not alter any assessment that is equitable within the municipality. And certainly, as you can see here demonstrated in this chart on the top of page 26, all properties are assessed at 8% cap rate. Mr. Chairman, just to conclude, I know that we've talked a little bit about this through questioning, and it has come up in the complainant's disclosure. But the subject property, it's not often that the subject property sells in the valuation period in an assessment complaint. And certainly for a hotel to have sold in the valuation period it tends to be very rare. And what we have here is a subject property that was sold within a year of the valuation date, very, very close to the valuation date. It sold for $17.5 million. Now, of course, we understand and completely agree that there are non-assessable years, both in the tangible aspect with respect to fixtures, furniture, equipment, TV, bed sheets, etc., and of course with the business value. But a lot of that value is attributable to the land and the real estate, the bricks and mortar. ultimately, when we look at what someone has paid, what the current owner has paid for this property, the assessment at 9.7 million is still very conservative when you take a look at what these properties are transacting at, specifically this one at $17.5 million. And that, again, just pointing on that, that's just on the top of page 27, Mr. Chairman. So I'll reserve a few arguments for my closing statements, Mr. Chairman. I thank you for your time, and other members of the board. Mr. Cook, thank you for bearing with me for the previous half hour or so. Our request, as I mentioned early on, we believe the assessment is fair. We believe that the assessment is equitable, and we would ask the board to confirm the assessment. And with that, I'll open the floor to questions.
Mr. Cook. Whenever you're ready, sir. Am I muted here?
No, I
No,
didn't
okay.
realize you were. I thought you were introducing me, but not requesting I do something. So
Mr. Cook,
Thank
the
you.
floor is yours.
thank you. Lance, if I may call you that, I would try and keep my questions brief. I haven't heard any interruptions there, so we're doing well. Just a few questions of you, my good friend. For example, on pages 10 and 11 under the Municipal Government Act, all properties have to be assessed under mass appraisal versus market value. Is that correct?
Correct. Yeah.
Right. And indeed, you point out on pages 10 and 11, the bottom of page 10, mass appraisal, and that the third bullet, for example, a uniform valuation model is created for each property group. That's correct?
Correct.
Then it goes on quite rightly. Single property appraisal is the valuation of a particular property as of a given date. Mass appraisal is the valuation of many properties as of a given date using standard procedures and statistical testing as per
Correct.
the Act. Yeah. So my question to you is, I think we've both acknowledged that clearly the subject has not been assessed typically, i.e. there's been no 20, 30, 50% stabilization incorporated in the subject assessment, correct?
Well, I would disagree. Again, I mentioned it earlier in my presentation that you do have instances where maybe you only get 2 years of information, maybe you only get 1 year information, but the process is the same from our side, right? We want to go 50, we want to go 30, we want to go 20. In the case of the subject property, when you only have 1 year of income and the other 2 is non-existent, 50, 30, 20 ultimately becomes 100% of the most recent year. But we do set out to make sure the procedures are the same every time.
Okay, maybe my question wasn't clear enough. The subject has been assessed based on 1 year's income, typically under mass appraisal, and the balance of the remaining properties in Canmore were assessed on a 3-year time period?
Yeah, so I'd have to check on other hotels, but there could be the circumstance, and I don't have the information in front of me, but there could be a similar circumstance with another hotel where maybe they had good information or good financials in that 3rd year and maybe the most recent, but something happened in the middle and they didn't submit, right? We would still undertake the same application of the process, i.e. 50, 30, 20, to derive the stabilized.
Right. And to continue then on to page 20, I believe I heard your reference, and if I'm misquoting you, please advise me, that you felt that the prior year's assessment, the reason why there was such a large increase this year is that the prior year's assessment was too low. Is that fair?
Correct.
That market value assessment was accepted and passed audit under the provincial audit, correct?
Correct.
So you have no evidence before us to show why it could be deemed as being under market value.
Well, I made mention in my presentation. So if you take a look at the income use in the previous year, I think it was roughly 3.2 million, we'll say. I can confirm that here.
It's close, yes.
Yeah, 3.2 million versus the current 2021 tax year. I think we're in the 3.7 million range. So the assessed income at 3.2 million, when we look back on that now, knowing what we know now, with information we didn't have back then, we can be fairly confident to say that, yep, if we had that information back then, it would have been higher. And what information am I referring to? I'm referring to the information of the most recent financials, the most recent income at 3.7 million. And I made mention in your rebuttal disclosure how the VP of Finance said the income has been coming down leading up to that 2020 year, right? So what that says to me is she may not have had solid financials, but she knew enough about the previous operation to say the financials have been coming down. The income has been coming down. So if it's at 3.7 in the most recent year, what that means to me is it had to have been higher for the previous 2 years.
Mr.
So
Chair,
when we compare, just to finalize on that. So if we compare that, if we say, okay, well, we know the previous income was going to be more than 3.7 million. And we now compare that to the assessed income of the previous assessment year at 3.2, we can draw the conclusion or be fairly confident in the fact that, yep, we should have been higher.
Mr. Chair, just for the record, with all due respect, in answering questions, I believe it's not an opportunity to represent the case. It's just it would be, I think, incumbent to answer the questions more directly. So I just wanted to make that note. I'll continue. What you suggested that there was a systemic change year over year with all of the hotels because of a change in assessor, and well done to you for getting the contract. So all of the hotels in Canmore suffered obviously the pandemic, but suffered the change or enjoyed the change in you taking over. And that was given as an explanation as to why the subject performed or its assessment is so different to everybody else's. Tell me, what was the average change in assessment year over year in Canmore for hotels?
Overall for 2021?
Yes.
I think it was in the area of -15, -16.
Right. So notwithstanding all the comments in regards to the change of agency or representation, assessor yourself, with everybody experiencing the same, all the other hotels averaged a negative of approximately 15%, and yet still the subject had a 13% increase. Is that correct?
Correct.
Okay. And I want to last be kind of brief because I appreciated your presentation. On page, you reference, I just want to reference the pages you referenced. Page 23, this was in regards to cap rate, as I understand it. You say to measure equity, a comparison of the assessments of similar properties is required. And you acknowledge, no doubt, that all the properties I utilized were similar properties, i.e. they were Holiday Inns. The difference being, I think you were trying to point out, was that they were in different locations, non-resort locations. Is that fair?
That's fair, yep.
Okay. And then at the end there, you reference a chart of advertised daily rates from just past this August. So that would be post facto information, correct?
Correct.
But further, I get what your point is, but you'd acknowledge, no doubt, that revenue is, the cap rate is very different from the revenue. I mean, there are two parts to that formula. The cap rates generally are symptomatic of the risk associated with the property, and it's immaterial to a degree whether they're charging $80 or $150 a room or whatever the comparable type of asset is?
Yeah, could be.
Sure. Well, in fact, I think you probably illustrate that in your chart on page, page 26. This is all of the hotels in Canmore, where they all have the same cap rate of 8%. But I'm assuming these don't all charge the same daily rental rate, do they?
Correct.
Okay. And just bear with me, I'm almost there, my friend. I guess I'm going to cross it in my rebuttal, but I just want to make the point, in regards to the sale of the subject, you mentioned it several times, and of course, it's always beneficial to have a sale of a subject in an assessment period, but unfortunately, we're dealing with a hotel here. Industrial warehouses, office buildings, and retail stores are all quite easily able to garner their realty component, but hotels obviously are very different. And you acknowledge, no doubt, even in your charts on page 29, that there are multiple other non-realty associated factors involved in the purchase price of a hotel.
Correct.
Okay, Mr. Chair, I've tried to keep it as brief as I could and fair as I could. Thank you for that. Thank you, Lance. Appreciate it.
Mr. Cook, one comment. There was no reason for you to keep it brief. I want to ensure that you've had an opportunity to ask all of your questions of the respondent.
Understood.
Have you asked all your questions?
I have. Thank you for that notation.
Thank you. I'd like to now questions from the board. Mr. Buckley.
Thank you, Mr. Chairman. Thank you, Mr. Wayloggy, for your presentation. I have only one question. I'll take you to page 25 of your disclosure. And you may have said something about this and I might have missed it in your presentation. The capitalization rates for Lake Louise and Banff. Instead of showing a single number, you show a range, 8.0 to 8.5 for Lake Louise, 7.5 to 8.25% for Banff. Are those different rates for different hotels in Banff? Could one have a 7.5 and the other have an 8.25?
Correct. So that's the min and max of the assessed cap rates for hotels in Banff.
Okay. Thank you. That's all my questions.
Ms. Williams.
Thank you. Just a couple of questions, really. Firstly, the change of ownership. I know we've kind of looked at this a little bit. And Mr. Wayloggy, you also mentioned that due to the previous assessment firm not requesting operating income from hotels in the town, there was a gap in information. If that information had been requested and there was a change of ownership, would you typically apply all of the 3 years of income? You're not saying that the change of ownership starts things afresh, I'm assuming.
In this case, I wouldn't. There have been instances in the past where hotels have changed in the middle of a 3-year period to the extent where there's a different flag. So for example, down here in Lethbridge, the Holiday Inn down here changed to a Ramada. When it was a older-ish hotel. You know, under certain circumstances, the assessor might look at that and say, well, maybe those previous years under the previous ownership, might not be relevant to the income stream going forward. Of course, we don't know because we don't have the financials here, but I even if I did, knowing that hotel, I think I would probably be okay with still using the 50, 30, 20 if I did have them.
And
So in
this
short,
case-
Yeah, I don't see any reason why I wouldn't use those financials if I had them.
Right. And I guess in this case, we are dealing with the same flag, as you say, so that hasn't changed.
Correct.
My other question is, just given the lack of this income information, does that cause a greater reliance on other methods of valuation in this case until that income is able to be stabilized?
So are you suggesting, did we think about a cost approach or
Yeah.
a different valuation approach?
I mean, it
We-
seems like it's an unusual situation.
Yeah, I can understand where you're coming from. I don't think there was at any point where I had thought, maybe we should do these on cost. I think even on that first year when we only got 30 to 40%, I still felt that, there's enough there that I think we could move or prepare these using the income approach. So I think the cost approach would yield worse results, poorer estimates of value, if you will. So no, I wouldn't have considered the cost approach.
Okay. They were the only questions I had. Thank you.
Thank you, Mr. Walagi. I have a couple questions. You identified that there's 3 issues before the board. Number 1 was the year-over-year increase. Number 2 was the weighting applied to the income, and the fact that 100% was applied to the only year that was provided. And the third one was the cap rate. The first year-over-year increase, that was an informational item raised by the complainant. Was it? Question mark.
Was it an information item raised by the complainant?
Right.
I'm not
In
sure.
terms of saying, here's what it was, here's where it is. With all this going on, doesn't seem right.
Yes, correct. Yeah. It was at first blush, this doesn't seem right.
Correct. And there was no request for the board to do anything about that beyond take that information.
Correct. I feel from my position, I mean, the reason why I felt the need to respond to it is because it is such an interesting fact that the assessment is going up when everything else is going down in the middle of COVID. It doesn't pass the smell test. So I felt that we needed to respond to that and provide an answer to the board as to why it was okay. Because at first blush, when someone puts that forward, the first thing that someone thinks is the assessment must be wrong, right? If everybody's going down and this is going up, well, it's got to be wrong. So the response there, simply put, is that increase in assessment doesn't mean the assessment's wrong. It's just mean we didn't have the information that we needed to prepare the assessment in previous years. Now that we have it, we're estimating the value of this property closer to what we feel is market.
Right. Does the legislation not say that each year is its own year of assessment and period? I've always understood, here's your assessment. It may have changed, interesting, but the appeal deals with this 12-month period.
It has been decided, and you'll see in our disclosure here, pages 28 to 31. ultimately speak to that, sir. They say every assessment is prepared independent of the previous. The previous year's assessment is not a starting point.
Correct.
And the fact that an assessment increases more than another property or similar property doesn't ultimately mean it's incorrect. There could be reasons for that. And
Correct.
all we need is to find out what those reasons are. And that's why I felt it was important to give those reasons.
Right. So, Mr. Cook, just a quick question. So this year-over-year thing was not an issue that required a decision from the board. This was an information sharing. I want to make that, I got to understand that when it comes to writing it.
Absolutely fair question, Mr. Chair. As you pointed out, or as I would point out, if I had said to you and Mr. Walagi that last year's assessment was X and I want a reduction of 13.3% from that number, hence I want whatever that is, Y, then I would agree that would be an issue and it wouldn't be appropriate. And I did.
Thank you. Okay, thank you. I just wanted to clarify that. Now I want to go to the weight applied to the income. And I hope I've got it articulated right. If I'm closing my eyes, it's because I'm just framing something here. I'm not falling asleep. You can rest assured of that. So what incomes are stabilized 20, 30, 50 over a 3-year period?
Correct.
This property was purchased late in Q2 of 2019. And no income was provided for the previous income. Information wasn't available.
Correct.
Through the owner, right? They may have got it, but they didn't provide it, right?
Correct. Correct.
The assessor would have known what those previous incomes were from the RFEs, which would have been provided on this hotel property for the previous year's assessments.
Unfortunately, sir, they weren't provided on this property, because the previous assessor obviously didn't ask for this information. And our first year we asked, they didn't provide anything, and I can understand why. So this was actually the first year that this property had submitted their income and expense information, to my knowledge. Maybe many years before they had done it, but I would say in recent years, this was the first year that we actually had income and expense information on the subject.
Okay, so if I could just go back, we have July 17, July 18, July 19 are the 3-year periods, right? I know,
So,
and July 20. So we want
Yeah.
July 18, 19, and 20 are the 50, 30, 20, right?
Correct. Yep.
And this property was purchased in Q2 of 19. And when did your firm become the assessor for the city of, for the town of Canmore?
October 2019.
So October of 2019. And you've indicated that this, so we have the property, they come in 2019, they're able to give financials for July 2019, July of 20 for the preparation of the 2020 assessment for the tax year 2021.
We had asked for those. They did not supply anything. And as I mentioned, seeing as that they only own the property for a few months, I can understand why.
Yeah, when they asked for July of 2019, they had been there all of a couple months. So
Correct.
There was
Nothing really to report. Yeah.
So you would have been involved in the preparation of the assessment for July of 2019?
For the 2020 tax year, yes.
Yeah. So the property hadn't provided RFEs. for previous years.
Correct.
And the first RFI that you got was the July 20 RFI.
Correct.
And because of that, you took year one. You took the income for at June 30 of 2020 and did no stabilization because you had no prior years.
Correct. There was no stable. So of course, we would still go through the 50, 30, 20, but of course, with 2 absent years, ultimately the 50 becomes 100%. So we accept, or the stabilized income ultimately becomes the income of that most recent year.
So there were $0 for 18. There was very little information for 19, right? Because they had only bought the property just prior to the June 30 date.
Yep.
And you had dollars for 2020. So as I understand what you've said, because there was a 0 for the 20 and the 0 for the 30, the 100 goes to the 20.
Yeah.
50.
Is that a traditional practice?
Well, in saying that, again, I want to make sure that everybody understands, the board understands that it's 50, 30, 20, right? But if you have 2 years that are absent, the only information you really have is 50% of that most recent year, which becomes ultimately the stabilized income. Now, again, Mr. Chairman, there's one more step on top of that, right? Now, that's just to get the stabilized income, right? So now, as the assessor, we go through the normalization process, right? And as I mentioned in my presentation, typically boards have not accepted a normalization on the income side of things because hotels are, I won't say unique, but they're different, right? They have different suite mixes, they have different locations, they have different ages, different amenities. Ultimately, boards have ruled previously that it's not appropriate for the assessor to normalize the stabilized income because that's the best reflection of the income that can be generated off that property. The normalization process typically happens in the expense side of things. And so ultimately, that's what I was pointing out to the board. When you take a look at their actual expenses are 68%. However, we normalized that a little bit higher to 70%. So we did stabilize, normalize, and then that's how we prepare the assessment.
Right. So the normalization applies to the expenses and the stabilization applies to the income.
Well, again, stabilized, you stabilize everything, right? Income and expenses, but typically you don't normalize the income and you normalize the expenses.
Is it the practice that where there is only 1 year, you apply 100%?
Well, in
A new hotel. You have 2 years of income, you have year 1, year 2. When you're doing the assessment in year 2, you can't do a 20, 30, 50 because you don't have 3 years. What are you doing?
So this is a really good example, is the process is the same, right? I would seek out to do 50, 30, 20, knowing that there's only 1 year of income for a new hotel. The key comes in the normalization process, right? So we typically will accept the income side of things because that's going to be the best reflection on the income side for that particular property. But in the normalization process, we can take a look at that stabilized expenses and look to normalize that with similar properties. So again, that additional step is taken to make sure that the subject property at least aligns with similar properties.
So I'll only make this comment and then I'll move on, is that it's 100% as it is, no No adjustment. That's, the complainant is wanting to do 3565 to come up at a reduced income number for the preparation of the assessment. They're accepting all of the other factors that come in to the adjustment, to the preparation of the assessment. And you're saying that it's industry practice to take 100% of the first year if that's all you've got. 1 year if that's all you've got.
Well, again, that's not how I would put it. That's how it looks at the end of the day, right? Because we only have one set of financials, right? But I want to be clear that the process is the same. We seek to do 20, 30, 50. Unfortunately, we don't have those 2 years.
Correct.
So 20, 30, 50, ultimately, the stabilized income results in that last year. And so to somebody just looking at it from the back end, they say, oh, well, he just took 1 year. So I want to be very clear to the board, that's not what the assessor thinks when he sets out. When he goes through the process, he's trying to make sure he does the same thing consistently, whether there's 3 years of income, 1 year of income, 2 years of income. Does that make sense, sir?
Oh, I think I grasp it. It's just, there's no second or third year, there's 1 year. And I guess in my view, there's 1 year and that's all we got. And that's 100%. And that becomes the income for the preparation of the assessment, period.
Yes, and I'm trying to tell you that that's not what we think.
No, but
Ultimately,
that's what you do.
Back.
There's a difference between thinking and doing. With all due respect, this assessment was prepared on the basis of 100% of the income for the 1 year you had. You may have wanted to have looked at 20, 30, 50, but you didn't have it. And I've heard you say that because we didn't have it, we have to take all of it in 1 year. And all I'm trying to say is that the standard of practice of assessors when you only have 1 year?
Ultimately, in this scenario, right, what happens at the end of the day for the stabilized income, if you only have 1 year, then ultimately the stabilized income is equal to that last year or the only year that you have.
Correct.
And I think I've made my point on the other thing, so we could probably, yeah, I think I've responded on that point there.
Mr. Chairman, can I request a break?
Yes, you may. And now what did you want to do with this break? Did you want us to caucus or did you just want a break?
I just need a break for a second.
Okay, good. Let's take 5 minutes. I'll come back. I'll see if I have any other questions. Thank you. Megan?
Hi there. It looks like everyone is back and the session is yours.
Thank you. We'll now reconvene. Just one more, if you'll extend me the courtesy of one more question, sir.
Of course.
Have you ever seen where there's been a stabilization in 1 year like the complainant is requesting?
Yep. Absolutely. Yeah, it's not uncommon, we'll say, right? I mean, we'd love to get 3 years of information. Sometimes we don't. I think it's important, sir, to understand that the assessment isn't just only prepared off of the stabilized net income, right? We have that additional step that we've talked about on normalization, right? So the stabilization process is done the same, and it's a starting point to then go further into the normalization process, which then you come up with the assessed net operating income, which is then capitalized.
Right. So you've seen situations where they've stabilized within a year.
I have before. Yep, absolutely.
And they would do that. Why?
Why would the assessor do that?
Yeah.
Well, for example, like you said, you have a brand new hotel. Maybe you only have 1 year of income because the hotel is just built. So, you seek to employ a 50-30-20, but at the end of the day, your stabilized income expenses reflect the most recent year because you only have 1 year of income and expenses.
Right.
Now, the assessor would take that one step forward. So the stabilized net income is ultimately a starting point, right? This is the facts that we have, and this is how we stabilize those facts. Now, as an assessor, we make the decision whether we need to adjust that to make sure it reflects typical market conditions for that property, or in some cases, it's within reasonable ranges, and we accept the stabilized net operating income as typical and capitalize that.
Okay. On the cap rate, just a question on the cap rate. When you show all of Canmore's at 8%, that was what you would expect, isn't it? When all of the hotels are pretty similar in terms of their profile.
Yeah, I would expect that. Yeah.
Okay. Any questions arising?
No, thank you, Mr. Chair.
Very good.
Sorry.
Can we now?
Oh, sorry, I do have one last
certainly,
question,
please.
actually. Just back on page 27 of Mr. Wailagi's report, just the second paragraph from the bottom, as noted previously, the assessor did not have reported income information for the subject property. So previously, typical revenues and expenses were used in past assessments.
Correct.
So-
Yeah. So if you, oh, sorry, go ahead.
Okay, I guess my question was, well, twofold really. As opposed to taking a phased in approach and using those typical numbers and then phasing in the actuals when you got them, you just elected instead to use the 1 year of actual data that you had. Could you blend that approach or not?
Well, in this case, there wouldn't really be anything to blend it with, right? We only have, within the 3 year period, we only have the one set of financials.
Yeah,
So-
but the point is, it says typical revenues and expenses were used in past assessments.
Correct.
So not
Correct.
actuals, right?
No, we did use what we felt were typical markets at that time.
Mhm.
Now, again, when we look back, as I mentioned, with the information that we do know now, would I have made a different choice? Would we have made a different choice as to what we felt was within a range of market typicals? I believe yes. So that's why I can come before the board here and say, you know, we were probably underassessed. And as I mentioned, I explained our reasoning as to why we felt that way. And had we had the information, I believe the assessment would have been much higher, such that year over year would have likely fell into an increase that was more consistent with the typical.
Mhm. And so across Canmore then, I know we're sort of looking at equity and people having the same basis for their assessments. If this was an issue with how these assessments were done previously, are hotels being treated equally or equitably?
Yes. Yes, I believe so. And I could go into depth on what's happened over the last 2 years. I don't think it's necessary, but in my opinion, I believe the processes that have been put in place in the last 2 with respect to collecting the information, dealing with that information consistently and equitably, and ultimately applying that information to what we would obviously use in preparing the assessments. So I agree with that, yes.
Okay, thank you.
Just the follow-up, sir. Did I understand correctly that there was a perception by a Benchmark when you became the assessor in Canmore that this property had been underassessed?
Well, to give you examples, sir, if you take a look, and feel free to do so on your own time, but if you take a look at the assessments of hotels over the last 6 years, you'll find a period of 4 years there where many of the hotels did not change in value.
And this is in Canmore.
This is in Canmore. So while our friends in Banff and Lake Louise and Jasper were experiencing year over year increases over that same period, the hotels in Canmore stayed the same value year over year. So yes, that's why we can come to the conclusion and say, well, it's likely underassessed if similar places are seeing year over year increases, and the financials have not been requested or used in the preparation of assessment, then yeah, I think we can be very confident saying that they were underassessed in previous years.
Does that comment apply to any other properties or just the subject property?
It's specifically in the lodging area, right? Because lodging is unique in that you need the actuals and the actuals income and expenses to form the basis for assessment, right? Whereas other properties, you may have other means to make sure that those properties, that you're getting that information, or you're making sure that those properties are assessed fairly and equitably. So in my opinion, the biggest, and we saw it last year with the increases, right? The year over year increases in last year's assessment were very significant in the lodging portfolio. I think in the range of 35 to 45%, just because they were so undervalued in years previous.
Okay, thank you. Any other questions arising? Very good. Mr. Cook, rebuttal, please.
Thank you, Mr. Chair, members of the board. My rebuttal, I assume, is entered as Exhibit C2, and it comprises 6 pages. So when we received the assessor's submission, disclosure, we had the very same questions that the board has just spent the past little while asking. And so to turn to, and unfortunately, for some reason, our rebuttals don't present page numbers, but if you kindly turn to the 3rd page, which is the entitled Respondents Market Value via Income Approach, Stabilize Revenue, this is where our rebuttal starts, and it is exactly on the questions that have been just asked. So to quote, on page 21, the respondent states, Since there was only 1 year of revenues and expenses provided for the subject property, stabilization was not done over the 3-year period. Only the 1 year period between July 1, 2019 to June 30th, 2020 was utilized for the subject property. This does provide an advantage to this property in terms of the assessment for the impact to revenue due to COVID, since all the weight for income and expenses was placed on the current year rather than relying on a stabilized 3-year approach. Well, I'd point out that is in contravention of the Municipal Government Act. But secondly, as pointed out, the respondent has used actual income from the current period of $3,741,900 in the 2021 assessment. So the respondent is utilizing actual income and typical expenses, a mix of approaches. It's not done with anyone else, so it's inequitable right from the get-go. Now, on page 76 of the respondent's disclosure, the 2020 assessment for the 2019 income year is presented with an assessed income of $3,252,150. So I've reproduced the chart. This is the prior year's assessment, how they got to $8,466,000. It was presented again by the respondent. We presented it as well. So if you look in the middle of the page, you will see a box which states actual income, $3,252,150, and then below that, potential gross income, the same figure, $3,252,150. Now, I don't think I'm stretching it when I say I think we can safely assume, and my good friend just answered the question, that this was based on typical. And quite rightly, it's exactly what the assessors have to do under the Act. If you don't have the data, you should rely on typical anyway, because you're grouping properties similarly. And as my good friend pointed out on his pages 10 and 11 of his submission, this is mass appraisal, and you have to assess similar properties in a similar way. So in answer to the question, this was based on what was deemed to be typical at the time, and that's when the assessment was created. There are, just for added information if the board members so need it, there are requirements in the Act that you respond to an RFI, and if you don't respond, the punishment is that a hearing, an appeal, is barred. So there are consequences to a non-response to a request for information, and clearly our client has responded. So turning to the next page, page 4, the respondent claims that because income data from the previous 2 assessment periods are not available, the subject probably benefits from having a 100% weight applied to the most recent actual income. Income from the previous 2 assessment periods is not available because the previous owner did not supply it. So a current owner should not be punished because a prior owner did not provide information. That's just basic common sense and law. In the previous year assessment, it is expected the assessor used typical market income in lieu of actual income, and indeed we've had that confirmed. The typical market income applied is $3,252,150. The current assessment shifts 100% of the weight to the most recent year, which is inappropriate, as we've argued. And then we do a little chart where we show that pictorially, graphically. Now, with all due respect, I believe most assessors use as much information as they can. And so they would look to the 2019 typical, and now they've got 2020, they would utilize both years because you always want more information rather than less. And so I believe, and my good friend, very welcome to correct me if he believes I'm wrong, but I have seen this done on several occasions. They would use a typical income from the income year of 2019, because that's the information you used the prior year, and typical weights to the extent possible to the weighted income for to the property. So in the box chart, the second chart in the middle of the page, you have the 2020 income year where you have the 3.741900 actual, and you have the 2019 year of 3,252,150 being typical, and you would apply your weighting to those. Now, there is no 18, so you can't apply any weighting to that because it would be mathematically ridiculous. So you'd apply your the 20% from 18 to 2019, which would render 50%. So when you look at this, the respondents claim that applying 100% weight to the most recent year is advantageous, is not supported when you review the assessed income in the previous year. This is evidenced by the year-over-year increase in the assessment of 15%. So on to the following page then. So if you were to weigh these 2 years of income, because you should weigh what you have available, the metrics of the following chart arrives at. The market revenue would be the blending of the two, as we presented earlier, of 3,497,025. All the other factors, of course, are typical and so should remain the same, rendering what could have been a new assessment for 9,103,193. Now, of course, that's much higher than what we're asking for because we believe in the significance of the pandemic, but we believe, having seen the assessor's response, that this would have been a more typical and expected result from an assessment. It's still an increase over the prior year, but it encompasses the 2 years of income. Now on to the final page, sale of the subject property. You heard some comments in regard to this, so I looked it up. I thought, wow, that's an interesting situation, but I'm very, very well aware of hotel sales and what they include and what they don't include. So on page 27, the respondent states, and I'll just paraphrase, the subject sold to the current owners for 17.5 million, and that's based on the original assessment from the prior year of 2019. The value was much lower, and they quote a 1.76 times the assessed value. However, for the purpose of valuation, this is an invalid sale that the assessor has brought forward, as the price for shares can have various motivations and different valuations. On page 60 of the respondent's disclosure, in the affidavit of transferee, it states under paragraph 2 that the consideration paid by the transferee is by cash, a mortgage, and an agreement for shares. Now, nowhere would you accept an agreement for shares as being valuable in valuing, so pardon my repetition, because it's not a typical transaction. As per the attached email from the owner's representative, this agreement for shares totaled 5.5 million, or approximately 1/3 of the purchase price, rendering the ASRs and sales comparison approaches presented on the pages of the following pages of the submission meaningless, because you cannot ascribe a value to those shares. What were those shares? What was the value based on? Were there income tax implications? Were there future considerations? There are so many factors involved in share transfers that you would never use that to support valuation of real estate. Why? The industry would consider it an invalid sale. And indeed, so I wrote to the client, as has been mentioned many times, and you see that at the bottom of the page. She wrote, the total purchase price for the hotel was at 17.5 million, which includes 5.5 million in share issues to seller and 12 million paid in cash. Revenue has been dropping due to COVID in comparison to 17, 18, and 19. So again, 1/3 of the purchase price was involving shares, of which we do not know how the value was calculated or to be estimated. Mr. Chair, members of the board, that completes my rebuttal. Thank you.
Questions from Mr. Malagi?
Thank you, Mr. Chairman. Just a couple questions, Mr. Cook, through the chair, of course. So just looking at the charts here, so the 2020 income year, so the income is 3,741,900. So we can say roughly, 3.74 million for the. We've been talking about that number for some time, and now you've entertained an approach that is bringing in the previous year's assessed income to establish a new value, correct?
Sorry, I was on mute. Yes.
Just want to make sure I'm following you there.
Yeah, you'll see, sorry, Lance, that figure is exactly the figure as presented on the prior page from the 2020 assessed detail report.
And so there's been a lot of talk of the previous year's income and whether it's underassessed, whether, you know, what it should have been, what it could have been. Ultimately, without the financials, we won't know for sure. But on the back of, so it'd be page 4 of your disclosure here, within that email, so the Vice President of Finance had said to you that revenue has been dropping due to COVID in comparison to 2017, 18, and 19, correct?
Yes.
So we can assume that the revenue in the previous years must be higher than 3.74 million-ish, correct?
I don't know. I can't assume anything. This is what she wrote. She wasn't explicit. There's no financial note. She didn't have the numbers, same as she reported to you and me. She didn't have the numbers for 17, 18, so I don't know.
Sure, yeah, and we're not looking at specific numbers or anything, but it would seem reasonable that if she said in previous year the income was higher, we could probably accept that from the VP of Finance that the income would be more than 3.7 in the previous 3 years, correct?
It's possible. Again, I can't confirm what she thinks.
Okay.
Other
Now,
than she wrote there.
Sure. So, I mean, if it's a possibility, do you think it's maybe more appropriate to use a higher income than 3.252 for the 2019, given that the income was likely higher for 19, 18, 17?
No, because I'm not aware of what the numbers are. And I believe in following the act, and it should be under mass appraisal. And the prior year was based, as we've heard, on similar properties and typical inputs. I accept that.
It's fair that, again, we don't know the numbers, and I agree with you there, but at worst, wouldn't it be the same then?
Again, my answer is the same as I just said.
Okay. Thanks, Mr. Cook.
You're welcome.
That's all, Mr.
Thank you. Ms. Williams.
I only have one comment, I guess, and it's just a question. The requested assessment is still 7.75 million, is that correct?
Yes, good question. That's the initial request. However, when we got the city response, I looked at that and, you know, this is based on the most information available because we both use 1 year. I'm going, well, here's a second year. If the board believes, and I understand why they would, that 2 years is better than 1, then this is what I would have expected to be an assessment under appeal. So it is a fallback in our submission as a rebuttal.
Thank you. Appreciate the clarification.
Mr. Buckley.
There we go. No, I don't have any questions. Thank you very much, Mr. Cook.
Thank you. Mr. Cook, I'd like to follow up on Ms. Williams' area of discussion. And I want to start with the 3252 that is on page 3. So was that based on some actual income data provided in an RFI, or was that an estimate? Was that a number for the preparation of an assessment? You follow my question? Is there?
I do, and I want to be very fair to my good friend, Mr. Walagi, that this was prepared by Mr. Walagi and not myself. But I think we've heard today that it was based on typical.
So
Not
what does
actual.
typical? What does typical mean? That means actual? That means data that was provided?
data that was provided by the returning hotels in Canmore for typical rental rates.
So the 3252 was not based on information that was provided by the previous owner of the hotel.
That's what I understand from Mr. Walagi.
And when we say the income year of 2019, that's a June 30th of 2018.
Well, yes, exactly. This is the year of general assessment 2019. So again, this is Mr. Walagi's data. He can correct me. I think it's actually it's the previous year's assessment. So I would assume that it is up to June of 2019. Thank you.
Yeah. When I saw so that was information as of June 30th of 2019.
Right.
And you're not able to confirm, I guess, and I'm not trying to be difficult, I'm trying to understand, where does the 3252 number come from? I know where the 3741 number comes from. That comes from information that was provided as part of the RFEs and information utilized in the preparation of assessment.
Right.
Was the 3252 a number that was provided in an RFE, or is it a number that was developed in order to prepare the assessment of the hotel based on what typical hotels were doing in Canmore? Right.
Again, I'm speaking for Mr. Walagi, and he can correct me if I'm going astray, because I definitely don't want to misquote or misparaphrase. But because it has been stated that the RFE was not returned by the prior owner, he had to quite rightly go to the market, as one should anyway, and look to typicals and presented this as a typical potential gross income based on review of similar hotels within the municipality.
Do you have any comment, Mr. Walagi?
That's very fair. That's very fair. We would engage in the same process, but if we don't have any actuals to establish a stabilized net income, then we skip right to the normalization process and we look to similar hotels to establish market typicals.
Right. So that 3252 would have been where the typical hotels that would be comparable to this hotel for the purposes of analysis, you would use that number, and then you have a number to go in and do an assessment. Mr. Cook, my colleague, Ms. Williams, asked a question around the number of where the 9, I'm trying to find the 9.1 number.
It's on the second last page.
Page 5? Oh,
yes.
I'm page. Yeah, I guess it helps if I get page 5 comes between 4 and 6, right?
Still
page
does.
6 there. So is that 9103, is that a formal revised requested assessment, or is it, here's another number if the board wants to look at it? I'm trying to understand what that number is.
Very good, and I will get to it in my final summary.
Okay, then leave it till there.
Sure.
Okay. Any other questions arising? Very good. Megan. I would like to move into
Oh, sorry, it was muted.
good recovery time. I would, the board would, prior to summaries, the board would like to go into private deliberations for a few minutes to discuss matters, private room.
Yeah, for sure.
And prior to doing that, I'd ask that the complainants and the respondent in your summaries succinct. What's the issue? What's the ask? What supports it? No new evidence, please. And I think we agreed at the front end that Mr. Cook goes first, Mr. Walaggy goes second, and if there's something that comes up, Mr. Walaggy, we've extended Mr. Cook the courtesy of a brief underlined summary. Okay, thank you. Megan, can we go to the private room?
Apologies there, technical difficulties. I went to the room and you did not. 1 second here. Okay. Did that
So
work?
when I join, do I have to mute or anything on the other end?
No, I think you would be set to go when you're in there. Okay, it looks like we're all back and we're caught up on the technology here.
Very good. We'll now reconvene. We'll move to summaries. Mr. Cook, on behalf of the complainant.
Thank you, Mr. Chair, members of the board. In summary, then, I believe the board has got a very good grasp of the issues before it. It's quite simplistic, really. We received the assessment from the owner, who was quite troubled by the significant increase year over year, and upon investigation, we agreed that it should be appealed, and with two planks. First, the stabilized revenue or income, and secondly, the cap rate applied as a test to the first approach. And in the knowledge that we all have that the market has declined significantly as presented in my submission, and no surprise to anybody here. Now, we attempted to recognize the pandemic effect, as it were, in our approach, because we only have 1 year. Both parties are handicapped that typically you'd have 3+ years of data. Neither party has. We're disadvantaged by that, and that's through no fault of our client or ourselves or the assessor. It's the fault of the prior owner of this hotel. But notwithstanding that, a taxpayer shouldn't be punished for the actions of somebody else that they're not related to. So we approached it as best we could. We said, well, this isn't right. We know the market's declined. We know across the province it's between 10 and 60% for hotels specifically, and we understand why, obviously. Revenue, room occupancies, have, as pointed out in the publications that I presented, have dwindled dramatically. And so how can the subject increase in value? Now, there's only one way a property would increase in value, typically, and that's if a big addition was built, they put extra 3 floors on, extra pools, or what have you. You know, significant material change to the property in a declining market. So we looked at we analyzed the revenue for the subject that the assessor has, and we were provided by the owner. And we suggested that if you only have 1 year, it contravenes the act to use actual from 1 year. It's mass appraisal, and it's well documented in the respondent's submission. Under the auspices of mass appraisal, you have to group similar properties together and assess them similarly with the same methodology. That hasn't happened in the subject. It has been assessed based on its actual income, and then the assessors use typical expenses. You cannot mix approaches or methodologies. You cannot use actual and typical. You have to use, according to the act, you have to use all typical. And that was done in the prior year, just quite correctly. I agree, and I sympathize with the assessor, because we have the same issue. We only have the evidence that we have provided to us. It will be better next year, and we've advised the owners to submit to the assessor because they need and want this information. And there's requests go out every year and under punishment if you don't. But doesn't mean anybody has to respond to it. You could have nobody respond to it. They're within their rights not to respond. But the act covers that. If you don't respond, A, the assessor's covered because they have to look to typical as best they can. And B, if you don't respond, you're penalized. You cannot appeal. So I believe, I work with the assessors, it's best for everyone. The more data, the better for everyone. And this is what the current client has done. So we looked at the 1 year and said, well, if you have 3 years, you weight your revenues when there's a significant change or a change. And there's been a significant change, a very atypical, rare change in this time period, has to be recognized. So we said, well, then we should wait pre-pandemic and during pandemic, because we haven't unfortunately got to post-pandemic yet. It's only appropriate. That's what you do. That's what assessors do in waiting. And so we waited. WEIGHTED. And our choice of weighting was 35-65. Why? Again, it was a judgment call. Couldn't be 50-50 because the 2 years are so dramatically different. In fact, as I pointed out, the revenue was 2 million less year over year than the prior year. So, it's pretty much a 35-65 split. And when we did the math and came to the final conclusion, as you saw, we came to a value of 7.75 million. And we compared that to the rest of the marketplace in Canmore and in the province. And what did we find? We found hotels declined in assessment on average between 15 and 60%, and the average and median from our calculations was 27%. And you've heard from the assessor that it was down 13%. We had lots of 13. We had lots of 15s across the province. So that's reasonable. It's right where we would expect it to be. Now, by way of return, the assessor says, no, we are using actual, and we're using for revenue, and we're using typical for expenses, which again contravenes mass appraisal, contravenes that. No others were indicated. We were not brought that, we did that for everybody, therefore it's equitable. It's not equitable. And why is it not equitable? The proof is that the typical change in assessment in Canmore for hotels was a decline of 15%. So clearly, when they were all assessed the same way in the prior year, and they all went down 15% this year, and the subject went up 13%, something isn't right. And what isn't right is the assessor adopted actual for 1 year. Can't be done, shouldn't be done, but it was. Now, we presented all reasons, and you've heard it all, so I'm not going to waste any more of your valuable time on this in regards to all the subsidiary issues. I did a capitalization approach. It was a test. And I thought 10% was a very fair, reasonable capitalization rate if I was valuing properties. And I came back to my final number. It was within 20,000 of the other approach. It was incredibly close. If it came 2 million apart, you say, well, that's ridiculous. But it didn't. It came within 20-odd thousand. It was so close to be, great validation, a little surprising by my own acknowledgement. So we then got the response from the assessor, and I hope it's clear. We've been in a very good relationship right from the beginning. We've been in contact and tried to work together, and we've come here. So be it. We disagree. That's only fair. But when we got the response from the assessor, we were surprised. I mean, we knew what they'd done, but we were surprised. So we looked at it and said, well, this isn't right. So I presented to you, if you've got 2 years of data, use it. So we used 50% weighting on both years, even though in fairness, perhaps to our client, we could have gone 30-70, 35-65, whatever, but we went 50-50, let's be reasonable. You got 2 years. And we came to a value of 9,103,000. Now, clearly, we don't like that number because that's a 8% increase over the prior year. It contravenes everything I've already told you and said in the marketplace. It's inequitable. It's an increase. It's inequitable. It is a much higher value than we believe is appropriate for this year based on the data that we've presented. However, we're not so arrogant to think that the board is going to say, we're going to accept your initial request. So it's a fallback if the board, for whatever reason, doesn't agree with our postulations and our opinions and our evidence, then we respectfully suggest if you don't agree with the initial approach, then this is a secondary approach based on what the assessor knew and had and could have been done to be more reasonable. It's not a 13% increase, it's still an increase. I think it's 6 or 7%. But it's an acknowledgement that this subject has not been treated fairly or equitably compared to all the other hotels within Canmore. So, Mr. Chair, members of the board, thank you very much for your time. Really appreciated the manner in which this has been conducted today. And that completes my submission in support of our requested value of $7,750,000. Thank you.
Thank you. Mr. Walagi.
Thank you, Mr. Cook. Can everybody hear me okay? Perfect. Yeah, I just want to echo Mr. Cook's comment about good relationship between himself, Benchmark, and the town. I think all avenues were exhausted to find a possible resolution. And as you mentioned, unfortunately, we couldn't see the eye, and we're here today to discuss the issues. And we've heard the main issue, as I see it, are in three. The first being the year-over-year increase, and simply put, we've talked about it in full, is that hotels are unique in the way that the assessments are prepared. They're very different than every other property type that an assessment is prepared for. And I think it's very critical to restate how assessments are prepared according to best practices in Alberta. The assessor asked for 3 years of financial information. The assessor would stabilize that 3 years using a 50-30-20. This gives us a stabilized net operating income. At that point, the assessor then would undertake the normalization process. He would go out to the market. He would look at what similar properties are doing and what the similar parameters or parameters of similar properties were telling us. If needed, the assessor would then adjust to make sure that the subject property is within similar parameters of similar properties. This is how we ensure we're compliant with the legislation. This is according to best practices. This is consistent with the way the legislation had intended for the preparation of assessments with respect to mass appraisal. I think the one thing that the board must know is that historically, assessors have normalized both the income side of things and the expense side of things. But in practice, when we have decisions come from CARB boards in the past, what that does is they direct us to how we prepare assessments in the future. And one of the things that was constantly an issue, and the assessor was constantly, we'll say, losing at, was normalizing actual income. Previous assessment boards have stated various times that the assessor to normalize the actual income is inappropriate. It's okay to normalize the expenses. That's okay. We can look to similar properties and normalize those. And that's according to best practices. But because hotels are very different with respect to amenities, location, age, suite mix, it seemed inappropriate just to normalize the income based on similar properties. So we've adopted that. It's something that has been gone through the boards, gone through the courts, and we've accepted that and put that into practice. That's why when you see here today, everything has been prepared according to best practices and is consistent with legislation. We are compliant. As the complainant said, we've met asset, we've been audited, we've been given thumbs up. There's nothing inappropriate here. And furthermore, it has been done consistently and equitably to all properties. Now, that is not what the complainant is asking you to do here today. In all three of his valuations, that's the two in his disclosure and the third in his rebuttal, he is asking you to do is to make a change which is not equitable, for one, and is not consistent with the best practice as we've discussed here today. Again, we've talked about the year-over-year increases. I've given you the reason. I think it's important to have a reason. We did not have actuals or any information on this property until this year. Unfortunately, when you look and establish an assessment based on market typicals, you have to draw certain conclusions. And unfortunately, when we did get the information that we needed, we would have made a different decision in a previous year. Ultimately, that has left a year-over-year increase on this property that, unfortunately, if we had the information, would never have happened. But that is the circumstances we are dealt with. We always wish we have more information. We wish it would came to us in a timely manner. That's not always the case. It's unfortunate for the ratepayer that this resulted in an increase, but it should have been probably higher in the previous year. And they would have experienced a decrease had we had this information. Finally, Mr. Chairman, again, I beat to death the weighting of the complainant and what he's asking you here to do, but no other property has been prepared using a 65-35 based on the last year. The way that the assessments have been prepared, as I mentioned, they're all equitable. They're all the same. They've all been done the same, using the same processes and procedures. We looked at cap rate, and the complainant would have you look at cap rates of properties in municipalities that are not similar. Edmonton, Slave Lake, these are not similar properties where any sort of comparison to draw a cap rate is reasonable. We look to actually similar properties, resort type towns. We look at Banff, we look at Lake Louise, we look at Jasper, and the valuation parameters fall in very nicely to how the town of Canmore assesses with respect to cap rate. So again, these are the three issues that the complainant has brought forward. We feel, again, number one, there's an answer for the increase. And the second and third issue, again, we feel that we are being 100% equitable and fair with all the hotel properties. We've established that, we've demonstrated that. We think that he's asking you to do something that would create inequity, and that's certainly something that the board doesn't set out to do. So in summary, Mr. Chairman, thank you again for allowing me to present. Thank you for considering my submission, our request to the board. Thank you, Mr. Cook, for your submissions and questions. And again, very good relationship. Lastly, Mr. Chairman, members of the board, we ask that the board confirm the assessment. Thank you.
Thank you. Mr. Cook, we were going to extend you a courtesy for one final comment, brief.
Thank you, Mr. Chair. It's greatly appreciated. Very briefly then, I do find it ironic that my good friend is prepared to march up the hill and die on the principle of consistent and equitable treatment when there's clearly the subject property has not been treated consistently or equitably. And that is the whole crux of our issue before us today. Thank you, everybody.
Thank you. Mr. Olagi, do you have any comment about marching up the hill?
No, I will leave the last word to Mr. Cook, and I will sign off and battle well fought. And I'm sure we both will respect any decision that comes down from the board.
Thank you. And on behalf of my colleagues, I'd like to thank you very much for a very professional and very interesting presentation of hotel issues to us today. And you'll have a decision issued within 30 days. And thank you very much for your time and effort. And it's very professional. Thank you.
Thank you for your kind remarks. Have a good evening, everybody.
Thank you all. Bye.
Megan, if you're there,
Yes,
you just take us back to the in-camera room for a minute.
sure.